class review. Most of you here in this room have been through this with us before, but between that and the post-lunch food coma, I hope you'll stick with me and I won't lull you into an afternoon nap. But this is riveting stuff. So hang in there.
It wasn't Thanksgiving dinner.
Okay, good. So we'll start on page 2. You see the table of contents again, riveting stuff, but this lays out the agenda for today's presentation. Looking right into page 3, we've got our ownership, our performance, and dollar value add broken out by cap, pension, and trust. Pardon me, pension, trust, and state fund. Happy to answer any questions if there are any, but fairly straightforward. Looking around, seeing none, I will quickly move to page 4, where we will begin the next couple of pages covering off the role, allocation, and constraints for the real estate investment program. So just as a reminder, the purpose of this is to build a diversified real estate portfolio and seek the highest possible returns within the constraints that we've outlined within the IPS. It is deeply diversified across investment vehicles, strategies, property types, vintage years, and it's a mix of capital appreciation and current income. We have our inception dates broken out for you by cap, trust, and state, the benchmark laid out, and the approved allocations and where we are within those ranges across cap, trust, and state fund as of 3/31.
Are you comfortable with your current allocations here?
I'm comfortable with it. Yeah, we're above our midpoint, so that might raise a question, but high conviction in the asset class generally. It's a great long-term diversifier of returns. There's hard asset downside value. There's current income. We're on the precipice of one of probably the greatest vintage years of my career. So, and we have a lot of dry powder that's been put to work lately, taking advantage of this recent repricing. So I feel really good, Mark. Yeah. Moving to page 5, we dive deeper into the investment policy statement. At a high level, we have our constraints at the top. We dive a little lower down where we see strategic constraints, our leverage limits, and leverage policy per each underlying strategy. Happy to address any questions on anything on this page or what we've previously covered. Moving right along. Page 6, we have a nice picture for you, and you can see how real estate fits into the broader cap asset allocation. On page 7, we break this down further and show you it based on strategic allocations within cap, and then on a geographic basis with international and domestic exposure.
Can you expound on the non-US? What is it? Where
Yeah, sure. No, great question. In fact, it's a really great question because that number has actually moved up to some extent in the last quarter or two, and that's primarily driven by a investment we have in a company called NewCold. It's in a fund, but NewCold is essentially 95% fully automated cold storage facility developer. They develop everything on a build-to-suit basis, so they don't take any spec development risk. They have contracts in place with existing tenants, frozen food suppliers, et cetera, and they do this on a global scale. So think Poland, think Italy, think Australia, France, England, and that's where a lot of our international exposure is coming from.
Does that particular company do any stuff in the US?
They do, yeah, US and Canada as well. In fact, we've toured a number of their facilities, and we'll show you one later today.
Cool.
Yeah, pretty neat.
Does it hang halves of beef or anything like that?
No beef hanging, no Rocky Balboa type stuff, but very cool stuff.
No pun intended.
A leader in the business, without a doubt. Flipping to page 8, we'll cover off the styles of private real estate investing, both on an equity and debt basis. And importantly, this table applies across the board to the type of equity or debt investing you might think of. And you can kind of think about this as a risk spectrum, moving from left to right, least risk to most risk. There's a lot of stuff going on here. If you think about leverage, It goes higher as you move left to right across these strategies. Return expectations go higher as you move left to right. Debt coupons move higher as you move left to right. Interestingly, and conversely, occupancies go lower as you move left to right. If there's anything on this page you would care to delve into more deeply, I'm happy to. Seeing none,
You have a slide that shows percentages of how much you have in each of these.
we sure do. Yeah, sure. If you just flip back a page to page 7, you'll see it broken out by core plus.
Sorry.
No problem.
Ethan, just a follow-up.
Yeah.
I'm looking at the capital markets assumptions that we went over last meeting. And we're showing core real estate somewhere around 5.8%, I think over the next 10 to 15 years or something like that. If you mix in these other things, and do you have an expectation, or what are you looking for?
Yeah, so I love that question, and it's really based on, my answer is based on where we are trying to structure and move this portfolio long term. And so when I think about the portfolio as a whole, and then real estate more specifically, I'm looking for returns that are ultimately accretive to our actuarial rate of return. If we get there, that means we're paying benefits. I'm accretive to the overall portfolio. And so we have made a move to start moving into long-term perpetual hold vehicles with vertically integrated operators that are essentially buying core stabilized assets and putting a little bit more leverage on it than you would traditionally see in a core open-ended fund. And then we're holding those, and we're charging the manager with operating those assets, maintaining relationships with their tenants, increasing the probability of tenant renewal, growing their rents, and ultimately growing those positions into a stabilized cash flowing position that is distributing to us an annualized net income yield that is meeting or beating our actuarial rate of return on a levered or unlevered basis.
Okay.
That's where we're headed. And it is my sincere hope and deep confidence that we're going to get there, and this is the right way to do it. If you think about most institutional funds, this is totally counter my philosophical point of view. Everybody is being pushed into these closed-end fund structures. It's an industry thing, and there's no telling from fund to fund how that fund's going to perform, what quartile it's going to end up in, if there's any persistence in that return profile. Meanwhile, they're spending 1.5 points charging somebody with building a really amazing portfolio with stabilized occupancy, with great debt, with great cash flows that oftentimes at the end of the investment period in the value creation process is accretive to our actuarial rate of return on just a cash flow distribution basis alone, just to pay that manager a fee to trade that away and crystallize or promote and pay themselves. I don't bemoan that economic structure in the least. It's a wonderful deal for the GPs. But what that means is we are realizing all sorts of frictional costs of buying and selling over and over again. And oh, by the way, we're taking blind pool or reinvestment risk over and over and over again, which is crazy to me and totally counterintuitive. So why don't we find somebody that we really like, have conviction in, like the space, it's got durable economic, sort of macro drivers, and pay them to actively manage a portfolio and grow our income streams and actively manage the assets. Values go up and to the right through time. There's no doubt about that. Yeah, there's volatility along the way, but we have a perpetual investment horizon, and we should be keeping our money in the ground, working hard for us and growing our cash flow streams through time and compounding our equity multiples through cash distributions alone, if nothing else. I mean, if you think about our actuarial rate of return, if we get there, and we will, if you compound 7-10 times, we've doubled our money. We have a perpetual investment horizon, 10 more years, 10 more years, 10 more years. Values just go up and to the right. Our income streams will just go up and to the right. Rents grow too. There's volatility along the way, but I'm focused on the end game. Was that helpful?
Yeah.
I know it was long-winded, but it was an important question and there was a lot behind it. So that's what I'm trying to do. That's what we're trying to do. And I've had the support of Dan and John and Rob, and honest to gosh, I don't know why everybody's not doing it this way.
Question for you. If I remember correctly, going back to page 4. The TFIP, or how do we say that, TFIP? That percentage as so high is partially explained because if I remember correctly, there's not a lot of in that account, and this will be a question for Dan and John. Remind me, what can we invest in? It's kind of limited. It's one of the, this is a good
We can't
alpha
invest in
producer.
equities.
Yeah.
Yeah, so real estate's higher there.
Thank you.
Okay, great. Thank you for the question. So where were we? The types of private real estate investment vehicles. So this is, as defined by our IPS, we have separately managed accounts, which we're moving into more and more, but really on a limited basis. Most of the work there, Dan, has already been done. Closed-end fund, commingled structures, we have that exposure. We will continue to have that exposure, but we're disintermediating those slowly in favor of and just keeping a sort of a small cadre of our highest conviction managers there that give us broader diversification, cost efficient, and then open-ended commingled funds. All the characteristics are there for you. I'd say we're moving out of our open-ended funds largely. The core funds, they've been pretty myopic, if you ask me, and had a focus on the 4 major food groups only for a long, long time. They also are open-ended in fund name only, and they just are not the most efficient use of our capital. They are foregoing a huge opportunity set that is the private property market that's out there, self-storage, medical office. They're starting to move into it now. They're beholden to the ODCE, which has been super constrained for super long. And it's just not the best way to go seek out performance and build alpha in a portfolio from my perspective.
Ethan, how do you make sure you have a sufficient amount of diversification, both at the property level and at the manager level in the SMA program as you grow it?
So I think about it from the holistic portfolio approach, Jim. And right now, I think we have 1,500 properties in our portfolio, and that's too much. Within a single separate account, we may have 3 to 6, but the idea is with each manager, you do a second tranche, you do a third tranche, and then ultimately, you might have 10, 20, 30 positions in medical office with one manager, which you could argue is diversified, or you could argue against that. I mean, everyone's got a point of view and you can debate that, but even one loss within a separate account, while that might have an impact on that particular line item, that's within the context of a $2 billion portfolio. So we're diversified, Jim, and that diversification isn't going well.
Ethan, would you define 4 major food groups for everyone?
Pardon me, thank you. 4 major food groups: retail, office, industrial, apartments.
Is the residential only apartment? No, like housing complex?
Residential, so when you think multifamily, think residential, because you can throw in seniors, you can throw in student housing, you can break down multifamily to garden, high rise, affordable, workforce, luxury. We go down wormholes. Industrial too, every property type, just there's a bunch of substratifications below that.
Something just newsworthy. You may have seen an article about some out-of-state private equity firms coming in, buying up mobile home parks in the state. Nothing. We are not in those funds. We would not invest in those funds.
It's probably good.
It's
You get lynched in Missoula and Bozeman.
You're here.
You're not bad, not bees in Laurel.
Oh. So Ethan, page 10.
Page 10 it is. Page 10, we cover off the types of real estate managers we have or have had. I say that because down at the bottom, public debt managers, we used to have a position with Fidelity in their real estate high income fund. That was a 1940 Act registered mutual fund. We no longer have that position.
We still have it in trust, right?
Well, pardon me, it is still in trust. It's not in cap. Thank you, John. We have been leaning in the second one down, private equity operators. These are folks that are vertically integrated, can do, bless you, everything from financing, acquisition, disposition, construction, property management, leasing. I firmly believe that that is the most efficient model. They own their data. They empower their people to make dime value add decisions at a level day in and day out that compound through time. Plus you avoid an extra layer of management fees and promote that an allocator would pay to the operator for actually running their property on a day-to-day basis. And for many different studies, that extra layer of fees is debatable, but it's somewhere in between the 80 to 180 basis points of savings, depending on whose number you look at and whose analysis is brought forth. But it's significant is the point. Questions? On page 11, we cover up at a high level sources and drivers of real estate returns. As you would expect on the left side, appreciation, depreciation, and income as the sources, and then drivers listed out on the right side. Most are pretty self-explanatory, but if you have any specific questions, I can go further. Seeing none, we'll go to page 12, benefits and risks. Listed out on the left, benefits, risks on the right. Similar to your comment, Cindy, risks, these are high level. So within each of these, you can sort of demarcate other individual sort of underline, like what's business risk? Well, what if the key man at the manager goes away? That's business risk. What's operational risk? Well, what if the manager can't lease the building, for example? These are just second level analysis of the high level risks that we're taking. But happy to address any in turn.
Where do you put something like a pandemic? Which category is that?
That is a 6 standard deviation black swan risk. And I would be happy to add that to the slide if you'd like to see it going forward.
It affects all of these.
But,
Yeah.
not to mention every other kind of investment there could be.
Yeah.
Counterparty risk.
Counterparty risk. So I'm a guy and I go out and I originate some debt. I'm now the counterparty. Maybe I go bankrupt. And so we're on the debt side of that equation, for example. Yep. 13. Here we have our life cycle of a real estate private equity fund, otherwise known as the J curve. We all love the J curve in private investing. This is where cash outlays early on outweigh inflows. And as we move through the life cycle of the fund, cash outflows or inflows outweigh the cash outflows. But importantly, you'll notice that those cash inflows start decreasing through time as well as assets are sold. And that's important to keep in mind as we move through the next couple slides, and I'll remind you of that in just a moment. Page 14, we address what annual pacing is. This takes into account our current exposure, our commitments relative to total plan assets. It considers contributions, distributions, our fair market value, allocation within approved ranges. It takes into account the annualized growth rate of our plan. It's pretty arcane and not super predictable, but what it does allow for is a lot of flexibility. You can play with a lot of inputs and generate a lot of outputs. You can create guardrails, bounds. We work with RBK in this regard. In fact, I've got a meeting with Kirby next week. Rob and I do. And we're also working on our own internal pacing model using Perplexity to really analyze all of our data historically going back through time to help us just give us another tool and leverage what we have at our fingertips. Given some of what I told you earlier, Dan, in terms of putting our money to work and keeping it in the ground, that means we're not getting it back as much. We're really hoping to build in a durable income yield that's current. Our pacing's gone down historically, and I think we have a slide in here. You know, we've been in the $250 to $400 million range, give or take. We're now sort of maybe in a bit of stasis at about 150 million, and we've really narrowed our focus in the funnel down on our, just our highest conviction, serially outperforming managers, while others are in current runoff and waiting anxiously.
Does the J curve effect kind of go away over time as we move further into this, or is it sort of hidden?
Next slide.
Okay.
So it will always be, the shorter answer is it's always going to be captured in performance. There's no doubt about it. But if you look at slide 13, if we just did commitment 1, for example, you would see how that J curve would mature through time, and then we'd sort of lose our allocation. So the idea is you need to stack commitments through time. You need to be steadily committing. As these cash flows mature and generate and move through the curve, you can maintain your allocation within that range by being consistent, by being methodical. We can't predict markets. If we stop committing, you can see just how quickly our allocation would drop, how those cash flows would just disappear, that market value would go away. So if we commit regularly, we can maintain our allocation without being forced to over or under commit in any given year, thus exposing us to any specific vintage year, for example. I would argue that by keeping money in the ground, really the thesis in real estate is to buy right, put good debt on a deal, good location with good tenants and good management. And you'll do great in the good times and you'll survive the bad times. And if you just keep the eye on the ball, we should profoundly succeed. And I think we're in a really great place and we're just getting better. And we're getting bigger, fewer, smaller, tighter relationships with our partners who are aligned with us. Everybody who's in an SMA, we cold called them. They saw eye to eye with us, and we're going to go build generational wealth with them as well while we're building generational wealth for the pension fund. If you don't have any more questions, I'm going to turn it over to my partner in crime, Rob, and he will take you through the rest. Rob, the floor is yours. Thank you for your time and attention. I'll see you a little bit later today.
Good, member of the board, good to see everybody today. Thanks, Ethan.
Yeah.
We've discussed quite a bit thus far, but some of the things you may still be curious about are what goes on behind the curtain prior to, during, and after an investment decision has been made. And as you can see here on slide 16, there are 5 key tenets to this ongoing process, all of which I will cover in greater detail over coming minutes. All right, moving on to slide 17. So first, I want to take a bit of a zoom out and take a big picture view of this whole process. I think this is a really great slide and it does a really good job at showing the sheer impact that this process has. As you can see, over nearly six fiscal years, 1,859 deals were sourced and analyzed by staff, while only 30 were actually invested in. A really important point here too is that while potential investment can be killed at any point in time, the majority are killed during the initial screening phase. We are always trying and looking to identify if an investment meets our criteria early on in the process so that we can efficiently allocate our time. Any questions? Hearing none, moving on to slide 18. A fair amount of this time is spent during the first stage of the process, deal sourcing. The most common sources of deal flow are listed here, with the top 2 being industry contacts and periodicals. And as Ethan just touched on, we actually do quite a bit of work when it comes to when we find someone that we really like and we think there might be a good fit, we'll actually go ahead and call those people directly. We're always trying to grow a network of contacts while also making a concerted effort to stay on top of what's happening in the real estate world. Any questions on deal sourcing? Alrighty, hearing none, moving on to page 19. Once we've sourced the deal, And it's passed our initial screening, which is constituted of a thorough review of the potential investment, discussions with the prospective manager, both over the phone and here in Helena, and internal discussions amongst staff. We then move into the initial review stage of the diligence process. As you can see here, our goal in this stage is to assess critical diligence issues early on and decide if we would like to move forward and continue with the full process. A decision to continue here will then entail very thorough items such as background checks and reference calls, a very comprehensive diligence questionnaire and data analysis process, as well as on-site meetings at the GP's office. This is all intended to provide us with a fulsome understanding of who's sitting across the table, how they plan to add value, and how they approach everything from compliance to culture.
From what to culture?
Compliance to culture. We want to make sure they're doing everything right. All right, hearing no questions about that. Moving on to slide 20. Should the complete diligence process go well, and we have a great deal of conviction in we have a great deal of conviction in an investment, the next step in the process is the cabinet meeting. Here, Ethan and I sit down with John, Dan, and the directors and go over the deal. It's important to note as well that this is not the first time that John nor Dan are hearing about the deal. We're in communication with them throughout the entire process. Once all pertinent issues have been discussed during this meeting, John and Dan provide final approval on whether or not to move forward. Any questions on the cabinet meeting? All right, hearing none. Moving on to slide 21. If the deal is approved, we then move into the next stage of the process, which is the legal review stage. This is a very collaborative process between staff and external counsel, during which we work together to ensure that the deal's terms, language, and provisions are acceptable to BOI. Any questions about the legal process? All right, hearing none, moving on to slide 22. Once the legal process is wrapped up and the dotted line has been signed, it's now staff's responsibility to monitor the investment, which is very, very important. This is done through a variety of ways, with the top view being reviewing periodic reports and financials, taking active roles on any and all advisory committees, interacting with GPs as much as possible, and then touring assets and GP offices as is feasible. Any questions about the monitoring process? Right, moving on to slide 23. So with all of that in mind, there's a few things that I want to highlight about how we're thinking about real estate today. First, we continue to prefer partnering with pure play, vertically integrated real estate operators. Ethan touched on a few of these items already, but just to reiterate, relative to groups who outsource asset operations, these groups tend to have greater asset level knowledge. They tend to respond quicker to market changes, and they tend to provide lower all-in fees. Second, we are very focused on strengthening the partnerships we have with our highest conviction managers throughout the portfolio. If a manager continues to do well, their strategy has tailwinds, and they are a good partner, we want to lean into that partnership. Third, we continue to be focused on needs-based real estate that are supported by long-term tailwinds. These assets are those that have high end user demand in good times and bad, and they provide the portfolio with a strong and consistent stream of cash flows. Before we move on to some property examples, are there any questions about anything that we've covered today?
Yeah, thank you. On page 23.
Yeah.
Maintain real estate debt versus equity for real estate debt exposure. What would you say is the kind of split there of real estate debt versus equity side?
There should be a slide in here.
Slide 7, Rob.
Slide 7. Slide 7. There you go.
And what kind of yield do we typically get? I'm just curious what kind of the debt for the real estate's getting.
The recent positions that we've been committing to have been mid to high single digits as far as yield goes.
Importantly, that's really focused on core real estate. So they're providing debt, they're not financing transitional business plans, they're not doing equity cash out refis. They're financing the acquisition of a core stabilized property, ergo why the yield is lower relative to a super opportunistic type fund manager that's financing the acquisition of a property that is 20% leased and has massive lease up risk, and they're getting paid for taking that risk, which we are not doing.
Do you ever have curiosity around, I mean, this is not curiosity, is not the right word, I guess, like a private equity debt or private debt.
Mhm.
Versus say the real estate debt. Do you ever think about melding them together or definitely separate in your mind?
That'd be a question for John.
We have kept them separate, so Thomas's world has private credit stuff that would be more the, private equity debt type things that are happening, so if it's, got real estate as a asset that's the backdrop, we put it into the real estate portfolio. And I know some places probably do it a little differently, but
No, it's interesting. I
you
think
gotta, pick which bucket you put it in ultimately, so that's kind of how we've tried to keep it as clean as we can anyways.
Thank you.
Any questions on slide 23 or anything else? Right. Then we get to move into the property examples. So as Ethan mentioned, as I'm getting things set up, as he mentioned a little bit earlier, our first video you guys will see here is on New Cold Fund 3. As a reminder, BOI committed 50 million to New Cold Fund 3 on September 13th, 2024. He did a great job explaining what they do and who they are. In this video, we'll see 4 facilities that are in the US and 2 that are in Europe.
What you're looking at are giant freezers that go down to minus 30, 40 degrees in some cases. Product moving through the warehouse, all automated.
That's good.
So are those,
It goes with the music. Yeah.
The racking system where they have automated crane that will go up and pick individual product packages.
So does a, say a Fosco or whatever, they basically say, hey, I'm delivering X, there's a fee associated with storage, and then when the shipping comes in and out, is that, I mean, what's the business model?
So think about food manufacturers who manufacture frozen food packages. They deliver it here. These guys process orders from Kroger's or Costco. They go in, there's an individual fee for loading, for unloading, for packaging, for picking, sorting. Every time a box is touched, there's an incremental charge. And they will go in and lease these up. As I mentioned to Cindy, these are all build to suit pre-leased developments. And so they will buy a 78,000 or 150,000 pallet position within an individual warehouse. And whether they use those or not, they're still getting charged for it at an overall contract level. And then each time a package comes in and is touched, there's incremental fees assigned to that. And then on the other side, they take those mixed orders out and deliver them to the actual retail outlet.
And then just to put this into context, if you've gone to Costco, you know what a pallet with food looks like, right? The average one of these assets, the average facility is about 100,000 pallets. So think about that. And then as far as height goes, about 100 to 140 feet height. So massive behemoth facilities, that, as Ethan mentioned, has several revenue sources.
I'm looking at all the trucks too.
With very few people working in
And
it.
then and once them out.
Constant movement,
Trucks.
Yeah,
Yeah.
they're really busy.
very little people.
Highly automated, which is
Automated,
what
got it.
really differentiates these guys.
Do we own the building or do we own the business?
In this case, we have an ownership.
All the above,
No, the above,
Okay.
it's the business in
Interesting.
town.
all the above.
Really?
Building the dirt, the business, the equipment, the trucks.
Yeah, and just to give you a little more sense there, I mean, they're fully vertically integrated. They own their own steel manufacturing and racking business. They own all of they have all the IP around the software that runs all the automation. It's a really, I mean, it's a really good business model. If you look at the underlying financials, it's very healthy.
Very interesting.
I wanna watch it again.
Later.
And Ethan has to do the voiceover, so.
Yeah.
Just record it with the echoey voiceover.
Apologies for that. I thought it might be helpful.
That was good.
I'll stay silent on this next one.
All right, on to the next one here, which actually, funny enough, we've put together a kind of food supply chain example for you guys. So we started with the.
Inadvertently.
We started with the cold stores warehouse, and now we're going to go over a grocery anchor retail center that's outside of Phoenix. It was 100% occupied as of year-end 25. It's anchored by Safeway. This is in a Sterling United Properties Fund 1. BOI committed $115 million to this fund on July 15th, 2025.
This is a retail facility. Retail facility.
Grocery anchor, yes.
Any questions about wonderful grocery anchored retail properties?
You say that with such enthusiasm, Rob.
Because they're
They're riveting.
They are riveting properties.
Everybody goes to a grocery store.
That's right.
somewhere or another.
Precisely
We said
correct.
that every day during COVID. Everybody's gotta eat grocery anchored retail, every day.
That's exactly right. That's why we're leaning in here.
If there are no more questions, that's what we have for you guys today. Really appreciate your time and attention. Thank you.
Thank you. Thank you, guys.
Visual aids.
Thank you.
Yeah.
Especially the big refrigerator. That was cool. It is a 3,000 square meters.
Went to the one. at-
Each of the facilities are about that size.
They're huge. You can't capture the scale.
How much power do they use?
Sell it to them. That far? I mean,
100 feet.
Okay, all right, moving on to tab 7, RVK.
Rid of the building's like 100 square feet.
Jim's gonna kick it off.
I am going to kick it off, Mr. Chair. A few comments about, in two phases on the capital markets and the investment markets. One, the first part will be sort of a backward looking that will provide the foundation for when Becky talks about the behavior of the portfolio. But I'll end up with a few comments about the current marketplace because there are some things going on, as you well know, that have historically had pretty powerful effects on the capital markets and on the investment returns available and risk taken. So if I'm on page of the executive summary book for the board, and I'm on page 2, the lower left-hand panel that shows market performance and economic indicators. just a couple comments about inflation looking backwards. You know, when we did our capital market assumptions at the beginning of this year, we had an internal debate about whether or not they should be lowered a bit or stay the same. Our assumption is 2.5%. We decided to stay there, even though the Fed looked like it was going to keep cutting rates and that they might achieve at some point their target 2%. But we didn't think that there was much evidence that was going to happen anytime soon. We did some forward modeling and said, even if it happens 3 or 4 or 5 years down the road, for the time period for a capital market assumption that would help drive asset allocation, you would still get 2.5% for over that period, and that's what you should bake into your current asset allocation decisions. We'll talk a little bit more about what's happening with inflation lately and the effect on rates as well. The second thing is there have been some pretty significant changes going on in the trailing year. This is as of March 31st, just a couple of months ago. And some of them are departures from where the markets have been, say, for 3, 4, 5, 6 years. So one change is that international stocks, as John, I think, mentioned earlier, have done quite well. And that's a little bit of an understatement. Looking at the trailing year and even the first quarter of this year, they've walloped US stocks. And that includes both developed international and emerging markets. Long time in coming. For some time, our own capital market forecasts have shown that they had a valuation advantage. But the composition and the love affair with concentrated tech positions has made the US market the place to be for a number of years. That has suddenly been a bit of a toss-up of late going forward, but also in the past year, that diversification into international stocks paid off for diversified investors. The other thing that I did want to mention was that real estate, just a very topical situation, has started to show positive returns. Part of this is because the troubled Central City office space, now remember these are index-based, has shrunk so much it no longer has the clout inside the index that it used to have. That's part of the market change. But the other part that has changed is that the yield that's available, income associated with the other parts of the real estate market, which are actually bigger than Central City, and certainly even more so now. The mention was of the 4 main food groups, is now causing the returns to turn positive. You can see in the last year, they were just shy of 4%, which I think if we had thought about this 2 or 3 years ago when real estate was really flat on its back, we would have not predicted with much confidence that it would have turned positive so quickly, and has remained so, looks very steady. The other thing that I wanted to say, and it has been mentioned quite a few times, is that this is a perpetual fund. It's an OpenDB plan. Many of the decisions that this group will make will really bear fruit 5, 10, 15, 20 years down the road. That's one of the challenges about being a trustee. But there's also things that you should look at that could, even though like the hour hand on a clock, they don't seem to move, before you know it, they are suddenly material or a material driver or influencer of what's happening in the economic markets. And that's in the upper right-hand panel. And you can see US debt as a percent of GDP.
Jim, just so you know, I need to stop you for a second. We don't have this. We do not have the executive summary,
Oh, don't have section 1?
Not in the PDF.
not in our PD.
Oh.
I didn't know that.
And I don't have it on my remarkable.
And I'm trying really hard to find it.
And I am too, and I'm trying to listen.
So I wonder if they
It
just
should have
loaded.
been- it should have been-
I can share this if you guys want. I can sit over there. I mean, obviously you should have it, but
We don't have-
Well,
I have a printout version.
I've tried to tell you the story in terms of the numbers.
Something just listening to
Yeah.
what you're saying, but I
so-
don't have a visual.
So just to go back to international versus US, We've got international returns for the trailing year ranging from about 21 to as high as almost 30. The S&P 500 was just shy of 18. So that's a pretty material difference. And real estate was just shy of 4%. Again, a pretty significant one. The one I'm talking about now is really US debt to GDP, which is growing quite steadily and significantly, and now stands at just over 120% of GDP, which when we were thinking about the debt crisis that hit the euro some years ago, that was considered like a very bad place to be. So I think this is one of those items that moves like the hour hand on a clock, but it's also very difficult to move back into safer territory, as has been found out during the European debt crisis. So this is something that we'll be keeping an eye on over the next several years, because it could manifest itself in a very material way. So those are the kinds of things that are underlying what Becky's going to talk about when she talks about the behavior of the portfolio through the end of March, a month or two ago. But
Why do you think the VIX is, I mean, that next point is the VIX and it looks like it's, would you say that's low or?
that there has been an eerie calm in the market.
Do you think that's
Eerie
because
calm.
would you say, does the proliferation of volume in the option market affect that, do you think, or?
No, because so long as a market is deep enough, then the marginal buyer or seller of options determines the price. And we've seen, you can tell from the top quartile events that when that happens, the price of the VIX can dramatically change and quite quickly. So I don't think it has to do with the breadth and depth of the market. I think it's plenty broad and deep. I think it has more to do with why equities have been so resistant on the downside to geopolitical events, to
Oh, yeah, sure.
so I mean, it would be very odd to see the VIX being a lot higher than this and still have equity valuations as steady and as high as they are for some time. I don't know if John wants to weigh in on this, but does that
Makes sense.
so yeah, those two things would comport. So the couple of things that are really attention getting right at the moment are not only we've been going through a year in which the Fed has found inflation resistant to falling below or falling to its target. Just won't do it. Just won't do it. And this was before geopolitical events raised their ugly head, before oil prices went up. And they were still slightly above our 2.5% long-term assumption. Now we have a situation in which they're no longer resistant to being pushed down. Inflation is resistant, is actually rising for several months now, and rising pretty notably. Now, admittedly, focused a fair amount on energy prices, but we know energy prices find their way into many different parts eventually over the coming months into the inflation calculation. So it is, and now we have the situation in which over the past 4 weeks or so, or 5 weeks, rates have suddenly risen. Rates have been very well behaved and very steady, but now the 10-year treasury yield is now where the 30-year was 5 weeks ago, just like that. I mean, that's really fast. And we know when the Fed raised short-term rates really, really quickly, that was very bad for the equity market. That was 2022. Well, I think we should all remember how bad that was. And yet the equity market seems nonplussed. When we look at the 10-year rolling CAPE, what are called CAPE PE valuations, they are close to their historic highs. So there is a couple of things that, and I've talked to a lot of people, I speak at a lot of conferences about why that is. One of them, of course, is AI. There's an expectation that AI could in fact really bolster corporate earnings growth because it is a efficiency driving entity or a factor. And we see that inside our own firm. We are now building our own software tools in the space of 5 days, where it used to take us 3 months to vet and write a contract with a third-party entity, a third-party software provider. It is truly amazing. So that's a possibility, but so it may not be completely nonsensical that valuations are this high, but it is worrisome. And it is clearly counter to the direction of where competing asset classes are going, whether it's real estate, whose income yields are now rising, certainly the fixed income market. The other explanation that we hear is what's called moral hazard. Moral hazard is when individuals think they can take bigger risks because of something. So the classic one that's used in driving, which would be appropriate for Montana, is that the proliferation of four-wheel drive SUVs has made people take more risks on the highway because I've got a four-wheel drive, and it's a different vehicle than I had 15 years ago. And there's you incrementally take on more risk than maybe you should. In the case of the financial world, it's, the Fed now has dry powder that it could push rates back down to ZIRP. ZIRP is zero interest rate policy, again, if it had to. And so there is this kind of, the Fed has come to our rescue in the past. When I say us, I'm talking about risk investors in risk asset classes, and they have room to do so, except for one thing. Their rates are already below where inflation, the last couple of inflation prints have been. And hence the expectation, if you look in the futures market, of additional Fed rate cuts has dried up dramatically because of the last couple of months of changes in inflation. About geopolitical events and their results, can't say too much about those. Those are so unpredictable, except to say that in only a few cases in market history have they had sustained like 5, 10, 15-year periods. The Great Depression is one, as an example, and World War II is an example. In almost all other cases, the market recovery rates after what appeared to be a disturbing geopolitical event has been pretty quick. That's just market history. It doesn't guarantee that the results of this particular geopolitical issue will go that way. But it is another explanation as to why these geopolitical uncertainties and risks haven't seemed to have put much of a crack in the equity market thus far. So that's a little bit going forward. Before I turn it over to Becky, I wanted to just see if John had any other comments about the current situation looking forward. We've had a little back and forth between us.
I'll save my dry powder for
Good.
later.
I'll turn it over to Becky.
Right. Just a real quick question. So did we resolve the version of the performance report that's in your online? now?
The online one did not have the executive summary. It's been emailed out to all the board.
Okay.
So everybody's got the executive summary. Everybody does have the performance.
The section 2?
Yep.
Okay, great.
We should label them.
It's
You
it's
did.
a little confusing.
We didn't.
They are labeled. We normally get them, but we did not get them on either our remarkables or files mailed to us.
So just to confirm, in section 2 on page 4 should be the pie chart that says retirement plans?
The colorful pie.
The quote chart.
Page 4?
No,
No.
that's the quote chart.
That's page 4 on mine.
Okay, so there should be another file that
Still
follows
the
that one.
executive summary one.
Yeah.
So now you're on the one that
On the second.
came into the remarkables and the.
Portfolio investment analysis, that's the one we're on.
Even the performance back.
Yeah, I see we've got,
I'm in, it says,
Quarterly investment performance analysis should be the.
yeah, and on page 3, there's another title that says retirement plans, investment pools and trust accounts.
So you said page 4, the one that's doing both.
Okay, so that's That's the executive
And-
summary.
That's the executive summary. You wanna go?
Becky, this is page, if it's helpful, I've got the combined book. It's page 114 of the combined meeting materials.
We don't have the combined,
no,
though. That
it-
doesn't help us.
You're on page 5. So Becky, you want it to say, it's the pie chart, retirement plans like this?
Actually, that would be, yeah, that's page 5 that has retirement plans, cap pensions.
Yep.
Yes, okay, great.
So
Say fine.
we are
Yeah.
off. So it's page 4, not on your remarkable, it's page 4 on the actual labeled pages. Or it'd be page 6 of 26 on your.
No? See?
We are starting out strong.
Right.
Yeah, this is frustrating.
Because this one, this was just an example, some quarter. Yeah.
Which one, what is it titled?
I think that's the web book.
Becky, what's it titled?
That's what.
So on page 4, for example, it says, on the upper left, Montana Board of Investments Asset Allocation Retirement Plans has a pie chart with 16.3 billion.
Savannah, would you please make page?
I've got asset allocation by segment retirement plans. Is that the one?
So, and it has BERS and TRS. This is what it looks like. No,
I think they've got the public version.
yeah, I think they
We
do.
all do.
That's-
Even what's the remarkable?
Yeah, it's just missing the risk reports and a bunch of things that I definitely want to go over. Paige, can you share section
You could trim up
2,
there, that
not the
would be
web book, but section 2?
Yeah, give me 1 second. I'll pull it up here.
Great. That's some of the same pages, but not all.
Do you recall, if we look at that, tracking on the performance of the fund, maybe John can help this as well. Over the past 10 years, it seems like there must have been some area of real outperformance in, say, 7 years ago to 8 years ago, 9 years ago. Do you remember what that was? I mean,
So.
of the fund as a whole, and why I'm saying that, it could be wrong. If we look at it and say we're at 50%, we're mid-range, 50 ranking now, 5-year, we're around there. 7-year, we jump up to about 16, and then 10 years around, say, 25. Somewhere in there, we really outperformed a certain segment, I would guess.
No, it could be just the opposite.
Oh, really?
It could be that there was a significantly bad year more recently, and take a look
Oh,
at,
sure.
and
Yeah.
take a look at 2022.
Mhm.
Where, the entire portfolio was down 8.5% in a single year. And so that
Sure.
that could account, that probably accounts for almost all.
Got it.
Yeah,
That's what I was curious.
we're gonna
like,
go through
What's the explanation there?
It's not that it was better long ago, it's that there was a bad year, relatively recently, that was driven almost exclusively by market
And
events.
it's obviously relative.
In fact, it was driven, to the point of my earlier remarks, by a major uptick in inflation, which the Fed then reacted to quite quickly. And it's why I've said to this board and every board I've talked to that, except for war on your own soil, inflation is the worst environment. Rising inflation is the worst investment environment you could imagine.
It's amazing that that chart that you guys have where it shows the 1970s, the timeline of the inflation and performance of that's tightly, I mean, looks very similar, obviously.
Yeah, it
Yeah.
sure does, doesn't it?
You were about to say something.
I was just, to your point, I think the primary reason, hopefully I'm answering your question. So if you look at the 5-year. We're at the 27th percentile from a rank perspective. You can see off to the right. So if you look at the performance number. Back there. You look at performance here, so we're 27th percentile. If you look at, we have all the individual years here, you can see we never ranked in the 27th percentile for any individual year
This is just the.
What we didn't do was we didn't blow ourselves up.
Right, diversification.
I think we discussed this. This is our Zen conclusion. The way you get into the top quartile is by never trying to force your way in any one year. Just stay above median for as much of the time as you can, if not all of it, and you'll get there over the
Right.
long run. Just mathematically, you'll drift right into the top quartile.
Thank you.
So if you want to run through what's on the screen, everybody should have both versions in your inbox right now.
All right, thank you, Dan.
But we got right there too.
Yeah, so
Yeah,
let's go
that's the
back
big
to
ticket
page
there.
4. Yeah, excellent.
Thank you.
I had two sets of page numbers while I was trying to prepare while Jim was presenting, so I'm glad I don't have to worry
I
about
should have
that.
presented longer and given you more.
Yes, yes, I got through, but then
But I
it,
wasn't as loquacious as I usually am.
oh, wow. So page 4, this is looking at the retirement plans, and thank you, Paige, for sharing your screen. So $16.3 billion is a combination of our retirement plans, and of course, we usually look at the market value for PERS and TRS in terms of their relative size at 7.8 billion and 5.5 billion. The moving to page 6, if you wouldn't mind, Paige, you can see the performance of PERS and TRS, both net and gross. We tend to focus on this page at the top on net first, and you can see, first of all, from an absolute return perspective, because of the negative markets we did have in the first quarter, you see that negative 0.67% on a net of fees basis behind our benchmark fiscal year to date, including that first quarter, a 5.4% rate of return. Now, just to give you a little bit of more current information and where we're rolling towards the end of our fiscal year, just on a calendar year to date basis now, the S&P 500 is up 7.9%. And the quarter we're in right now, the S&P is up 12.8%.
And the 17 was annual?
The 7.9 is calendar year to date,
Okay, so.
and then the quarter to date for the S&P is 12.8%. So you add that 12.8% to that negative 0.67%, you can see that, just looking at our equity portfolio, it's really helping improve that.
And this is a classic example of why you should never put too much weight on a single quarter.
Yes.
I mean, it will mislead you almost every time.
Yeah. So fiscal year to date, a 5.4% rate of return. You can see for longer periods, the statement that as we look at our assumed rate of return that both retirement systems talked about, our long-term since inception return's been 7.8%. So well ahead of that, which is certainly something we love to see. The intervening years, obviously 1 year, 11% rate of return. It was a period for equities outperforming. 3 years, a 9% rate of return. 5 years, 6.8. That is including that difficult 2022 when equities and fixed income corrected simultaneously, the worst bond aggregate index experience that we have had in the history of that index. So that was a tough year. And so on. So relative to our benchmark, we're a bit behind in the nearer periods, which we tend to be because of primarily the private market investments that are not marked to market as frequently. We compare them to public markets. We'll have more supplemental information on that, as you know, in just a few minutes. But longer term, we've either been above our benchmark net of fees on an annualized basis or just above it or right at it if you look at the 10-year period. So good, strong, absolute performance, relative performance, meeting long-term expectations. If we look at the gross of fees comparison.
And in fact, if you look at that 10-year number,
Mhm.
that's more than 1% above
Yes.
each year on an annualized basis, your assumed rate of return. And what that means is that the investment program has been a force to push up the funded ratio and the health of the plans.
Right.
Over the last 10 years, the performance of the portfolio has been a boon to the financial stability of the DB plans.
Absolutely. And then the ranks that we were talking about a few minutes before, you can see how those play out for other public funds that are greater than 5 billion. Near term performance has been closer to median. Long-term performance has been top quartile or better, or just missing it in the case of 5 years. So again, very good relative performance. And for 20 years, you rank in the 7th percentile, in the top quartile for the last 10 years, and then in 7 years in the 16th. So a lot of good relative performance. If you'd like to move ahead to page 9, we'll look here at the structure compared to your peers. We're looking at the 2 large retirement plans, and this is the same return information that you saw before. The main point of showing you this page is just to show you how peers are allocating compared to your asset allocation structure. So on page 9 at the bottom, the green diamond shows you where you are relative to peers. And we've got various shades of gray that show you the various quartiles of how peers are allocating. There's a median figure in the table that's just down below. So the way to read this is US equity, you have roughly 27%. The median plan has almost 28%, so very much in line. If you look at non-US equity, you have about the same as median at around 15%. As you look at fixed income, just slightly lighter in US fixed income than the median, but when you combine it with non-US, which is the next column, you have almost the same exact allocation to fixed income between those 2 categories. Alternatives, you're right at the 50th percentile in terms of your allocation of 23%, which is right on top of the median, although there is quite a divergence in the composition of alternatives for other public funds. We don't have hedge funds here in Montana, never have. There is a hedge fund component in that overall alternatives allocation, as well as other things like infrastructure, private credit, et cetera. So your composition is unique, but the total combination of alternatives, which are largely private, is right on top of what others are doing. Real estate is really the category where you have a higher allocation than other peers at 12%. Again, the attractive features of real estate, and our prior presentation went over this, but the diversification that real estate gives you with equity is quite powerful. Here you have an asset class that is really throwing off, in the case of real estate, income, which is so helpful when we're paying benefits in the retirement plans. And it tends to behave very differently than the equity markets. And I'll show you a correlation number a little bit later in the risk report that shows the value of having this in the portfolio. So you do have a higher allocation than peers at 12% versus about 6% for the median. This is not a recipe for how to allocate to be exactly like the median plan. It just helps us understand our relative ranking over time.
So why do you think real estate in particular, other plans are less concentrated in that sector?
Some have had less of a history or have chosen a different path in real estate. As Ethan had talked about, you have very different risk profiles. A lot of plans really concentrate in those core funds, the Odyssey type of funds that have a lower degree of leverage. It's a lower expected return. Others have had more private equity-like expressions of real estate that are much more highly leveraged, perhaps concentrated by sector. They may have other private asset classes that they have made room for inside their alternative budget, such as hedge funds, and that may have eaten into some of the real estate allocations that they may have used, and private equity.
And currently they're carrying 2% more cash than you are.
Yes.
So, you know, you are essentially are putting more money to work in a real asset. And again, you only know in retrospect whether that was a better asset allocation decision or not. But to John's point, and this is backed up in later on in the risk report, what it has allowed you to do is to avoid major downsides. You'll see that your downside capture, when the market goes down, the amount of that downside that you experience is attenuated. And I think it's attenuated largely because of your broad diversification, but also because of the way you've chosen to diversify, and real estate being the most significant difference.
And in fact, on the next page, we're gonna see that on page 11. We've got here, and this is in the risk report too, but I thought I would go over this page in order. And the earlier part of our commentary. So here is 10 years.
We didn't know it was gonna be on the next.
Nice work, Jim. Nice work. So this is the public employees plan representative of the other retirement plans as well. In terms of expected return, we have outperformed our benchmark. We've outperformed the median plan. And that is, you can compare the numbers that are down in the table section at the upper left-hand section of this page, or you can look at it visually, where the green diamond is. And we are certainly above the median horizontal hash mark, and above spatially as you look from top to bottom where our blue dot is, which is our benchmark. So the other boxes or other plans and where their 10-year results are. And so that certainly is a good result. We like having less volatility. We actually have volatility that's very much in line with peers, just a little bit less, but less than our benchmark. And we've talked about the reasons for that in the past, but we have outperformed, which has been terrific over a 10-year period of time. The up-down market experience that Jim referred to is on the right-hand side. And in the up markets, we participate. We may leave a little money on the table there because we, as on the right-hand side, we're actually protected on the downside to the extent of about 2%. We've had about a 2% better downside market
Which is very
experience
substantial.
than the benchmark. And when we look at a pension plan and the obligation to pay benefits over a long period of time, we like having that downside protection because typically that really protects the plan over the long term. So you may find an endowment and foundation that really can go for the gusto from a risk perspective, and they may not care that their down market experience is below their benchmark if they can participate in the up markets and beat it there. But for the type of risk profile that you have for pension assets and the other assets that you run, this is a very nice trade-off.
Especially if you're a mature cash flow negative plan. This profile is far more appropriate. And you might say, and I apologize, I'll cede Florida in a minute, but you may, it's almost another Zen conclusion. How can you have a return that is above the median return of plans when you have an upside capture of up markets that's lower than your peers? And the answer is because you have a downside capture that is way diminished versus your peers. I'm sorry.
No, so on back to page 9, I thought it was interesting that our cash position is probably the lowest, of the peers. Which is in one way great because that means we're allocating what we have. I was just curious as to how that has fluctuated over time. And do we consider, because we have that other pool that is just strictly almost cash, right? Do we consider that as a whole or separate? Yeah, okay. Thank you.
One thing I would note here, so what this is not picking up is so we kind of have two, so this is picking up CAP. So the consolidated asset pension pool, okay? But we generally keep 1% cash at TRS and PERS, which we count internally, and that's because they're paying benefits, right? So this is really kind of artificially making our cash look a little bit lower than it actually is, because we do keep some cash there because they draw regularly and we want to have that cash available for them, and we don't, they pull it as they need it and are paying it. So when they pull each month, we will just kind of reload cash. Right?
And other
So
plans do similar
philosophically,
things.
so there's a little bit more cash here associated with the full pension and sort of what this should.
Well, a number
Appreciate
of your
that.
peers do the
Phil's up.
same thing though.
Yeah, philosophically, what do you guys think from a cash as a stabilizing position, or are you like, no?
It doesn't, in the past, remember, we've just come out of this very long history of low interest rates or zero interest rates. It was a penalty to have
Right.
more cash, to get the diversification of having a great equity correlation, a very low equity correlation. Today, it's not as much of a penalty. But at the end of the day, most other asset classes are expected to outperform cash. So we don't want to strategically load up on it other than for operations.
Cash has two purposes. One is to actually allow John to run the fund. You can't run it without, it's kind of like running a car without putting any oil in the engine. But the other one is that from an asset allocation point of view, depending on what cash yields are, it can be additive or it can be subtractive from the multi-asset class portfolio's performance. But one thing we can say is that it is relatively strongly uncorrelated with risk assets, particularly equity.
The last thing I was going to cover on page 11, we don't typically necessarily point out this ratio all the time, but periodically it's nice to look at it. The Sharpe ratio is the risk-adjusted excess return. And you could see the second column in the bottom section of this report, second from the left, is showing you rank in the 28th percentile compared to your peers in terms of risk-adjusted excess return. That's a pretty nice place to be. And of course, you're beating your benchmark significantly there. These are long periods of time, 10 years. That's a very nice observation.
Should any of your constituencies argue that you are taking too much risk, the behavior of the portfolio profoundly says that ain't true. It just ain't true.
On page 12, and again, thank you, Paige, for turning for us. On page 12, you can see the CAP portfolio, which John had mentioned. The trust fund investment pool is shown as the second light blue line, and its comparison to its benchmark, as we also talked about before, in terms of what it invests in. It's not investing in equities. And for the fiscal year to date, a return of 3.6%. So we wouldn't expect that this pool in a positive and upward moving equity market would perform as well as CAP and our retirement plans. And then the STIP, a terrific return for our cash portfolio of 3.2%. Again, there were a lot of years when that was quite low, and it's nice to see that number. And the totals for these pools are at the bottom of page 12, and the CAP is about 16 billion, STIP is 8 billion, and the trust fund is 4.2. So the following page 13, this is another expression of, basically taking this CAP pool that the retirement plans participate in and showing you visually what the allocations are among the major asset classes. And if you're, adding those asset classes together, you can get basically a 43% allocation to traditional equities, fixed income of 22%, private assets of 17%. And when you look at the real estate, 12%, and real assets, 6%. So this is the big buckets that we participate in. Page 14 shows you the asset class performance, and this is shown on a net of fees basis here. The following page will show you ranks and how you stack up relative to peers there. And the domestic equity portfolio for periods of 1 year and shorter, you may recall this is a passive portfolio. And so really any noise in more recent periods since the active managers have been terminated is just a function of whether there was more small cap or mid cap relative to the overall market. But here you can see the return for the fiscal year to date. You've gotten a 7% rate of return for domestic equity. And international equity, which is the next set of information below, although the quarter was negative for both domestic equity and international equity, fiscal year to date, you've beat your assumed return by over 3% just in international equity. Part of that is the dollar. The other part is local currency returns. So very nice lift there. And we'll compare its performance a little bit behind the benchmark here. Its active managers have had a tough time in the international equity space. Some of their decisions about allocations to various countries and what they're weighting and overweighting has been difficult for active international equity managers. And you have a combination of active and passive and some managers you've terminated as well. So again, great absolute returns. And just look at the 1 year, a 24% rate of return for international equity is incredible. Fixed income for the fiscal year to date, a little over 3.3%, almost 3.4%. No issues with your benchmark for all trailing periods. Non-core fixed income, so it's picking up the bird. High yield, also convertibles, emerging market debt. And that has been an enhancement to the return of your overall fixed income exposure with returns of 4.7, beating its benchmark for the fiscal year to date out to 3 years. Real assets, here you can see that the benchmark was a pretty big return. This has been an interesting period looking at natural resources, infrastructure stocks, et cetera. So as we look at real assets, you earned a nice return of 5.9%, but your exposures look very different than some of the benchmark returns right there for the fiscal year to date and the quarter. Real estate, we just went through a deep analysis of that portfolio. Fiscal year to date, a return of 2.7. To Jim's point, it's been nice to see real estate turnaround, having a positive yield and having some of the stabilization in the prices of those properties has been great. That the cash portfolio return of 3.3 fiscal year to date, and the private investments have had a 2% rate of return. And here we've got a couple measures. One is this custom index. This is not private equity by itself. It's private credit and private equity combined together. And its benchmark had a very strong return. The custom index had a very strong return because of the very strong returns primarily in the equity markets, the small cap and equity exposure generally. When we look at the Cambridge, which is the new comparison we put in there, as you know, this is a blended index that picks up both venture and buyout, trying to match your exposure, especially recently. It's a universe of thousands of funds with all risk profiles, from those funds that an endowment and foundation would pick that may be more aggressive to those that are more, have less leverage, different parts of the market that may be less overvalued. The returns are more modest than the broad universe. But this just gives you an idea of what's been going on in the Cambridge universe from a return perspective. And as we've noted in recent periods in looking at the performance of private investments, especially the private equity component, it has not compared favorably compared to the public equity markets, but keep in mind what's been driving the public equity markets. It's been AI and technology. Without AI and technology, our domestic equity market has had much more modest returns. So that is something to keep in mind when you look at that long-term comparison or interim term comparison. For 5 and 10 years, actually, as you look at 5, 7, and 10 years, we beat that custom benchmark handily. And in the long term, you've had an 11.8% rate of return in private investments, beating your benchmark. You're about 50 basis points behind that long-term Cambridge comparison. Again, all kinds of risk profiles in that comparison. So that's a bit about private markets. And the next page I was going to go to is page 15, which is evaluating how each of your asset class pools have compared relative to peers. So this is taking the domestic equities of public funds and showing how you compare and rank and the universe size. You can evaluate here the fiscal year to date and quarter for domestic equity, near term performance for the fiscal year to date. And quarter is about median. Longer term results are very high because passive management has been what has been in favor. When we get these big rallies and just a few names in the index and index concentration, it is very hard for active managers to outperform. So you have outperformed your peers significantly by the structure of your domestic equity portfolio. International equity, you can look at that comparison. Generally above median with longer periods a bit below median, but even though you've been behind your benchmark, you've been ahead of your peers. This is showing you peers are struggling with their active managers too. Core fixed income, your portfolio is a little different than some public funds. And so here we've actually shown you a universe of fixed income accounts, not just public funds, because you have core that you manage internally. Then you have your non-core exposures. A lot of public funds put those together in one portfolio, and that's how the rank would be evaluated. Here, we actually show you compared to similar mandates, how you've ranked. And your core fixed income has been close to median, recently above median, a little bit below in prior periods, because some of those fixed income peers actually have high yield in them too, and emerging markets in them too, and convertibles, and you don't. So you have a bit of a different structure. Your non-core fixed income's done pretty well, especially in nearer term periods, ranking extremely well. The quarter a little bit behind. Real estate, very good performance in near term fiscal year to date, just missed the top quartile. Longer periods has been around median or a little better. And then finally, trust fund pools, we actually compare you to what if you were just in fixed income? How would you rank? And you've ranked quite well in near term periods and longer term periods with a little bit lower rank in 3 years. So there aren't a lot of concerns to point out here or different trends than what we have followed in the past. So let me pause here before I go to a couple pages in the risk report, and then I'll wrap up.
Let me mention page 16, if I could, Becky.
Sure.
And that is, we talked about that the portfolio has followed a comprehensively conservative approach, not way out on the spectrum, but conservative relative to the returns that they've achieved. And one of the things we look at that I often mention is that on page 16, that green dotted line, that's the equity beta line. And it is one of the indications of how sensitive the total portfolio's behavior would be just to the US stock market. And we know that the US stock market probably drives, or equity generally, probably drives something on the order of 60 to 70% of the volatility of the portfolio up and down. And it turns out that you are standing right a square, the middle, literally right on the median equity beta of the peer universe. That I can see that from an earlier page. You're at 49 and they're at 50. So the point is that your sensitivity to a very highly valued US equity market, which we don't know if it'll continue that way or whether or not something will cause it to break, you are not making a big bet on the side that, oh, it can only get even better from here.
Great point. Well, Paige, if you'd like.
Could you say that in different words? I mean, I guess what I'm hearing is we're about, the beta is about 0.6, 0.6.
It's actually 0.5.
0.5, that's a green dotted line.
And so that's saying that we're about, if the market moves up 1, we'd be 0.5. If it goes down 1, we'd be down 0.5.
Roughly speaking.
Yeah. I'll have you go ahead and turn to page 22. In the risk report, I'll hit just a couple pages, then I promise I'll be finished and take any remaining questions. Please interrupt me as we go along. We talked a little bit about your Sharpe ratio, your risk-adjusted excess return compared to peers. This is actually showing you what the numbers have been over a long period of time. This is rolling 5-year Sharpe ratios. And in the upper right-hand corner, just looking at the numbers, since there's a ton of lines here, these are showing the Sharpe ratios of every single asset class, composite. In the upper right, this shows you that you have had a Sharpe ratio, a risk-adjusted excess return that has beat your peers for 3, 5, and 10 years. That definitely is a nice result we like to see. Page 24 is looking at risk and return. Again, this is a risk-oriented lens of your report. We look here at the all public funds comparison, which is right above the 8% standard deviation, dark diamond, PERS, which is up and to the left, which is meaning that we beat those public plans, net of fees and gross of fees is in the green diamond. All the asset class tools that we have in our structure are the other diamond or the other dots that are surrounding those diamonds. And so when you look at each one, they all have different roles in the portfolio, but it's just interesting to see where they are. It's been nice to see international equity in the yellow dot that has had so much more volatility in the total fund, which we would expect. And recently it's had much better performance. But during this particular 5-year period, domestic equity, of course, has outperformed everything else. And it has about the same level of volatility, if not a little bit more. The other asset classes, as you work your way counterclockwise, real assets have had a much lower return or lower volatility than equities, but again, an attractive return. Private investments, again, a different volatility, not to mark to market as frequently, but you can see its return has been attractive. And again, working our way around counterclockwise, you can see where real estate has been. It's been a challenging 5-year period for real estate in the last couple of years. Much lower volatility, had lower return, but over time we think that will be improving. And then our core fixed income, very low risk, as you can see, and the non-core component outperforming with a little bit more risk. So it's interesting just to see where your total fund is and then where the asset classes around it are in terms of their risk and return contribution to the portfolio.
Is that private investments, is that using the Cambridge, or is that using our blended?
This is your actual return instead of using
great.
the universe. Yeah. And then I'll have you skip ahead to page 26. One of the things as we go into asset allocation season later in the summer with staff, and then as we have a meeting together to talk about that and any recommendations, we do a tremendous amount of work together collectively, including your staff, to make sure that we have the right level of risk to be constructive to the long-term needs of all the portfolios that you're responsible for overseeing. And one of the things we do have to watch is how much volatility is driven by equity. For most plans, most public pension plans, and a lot of institutional investors, if you look in the bottom right-hand corner of this page, this is the contribution to volatility risk. And if you just observe domestic equity on the left-hand side, the current midpoint for domestic equity is 29%. Actually, your domestic equity is contributing about 55% of your volatility, much more than its actual allocation. And this is true for every system that we work with. International equity, it's not quite twice the amount of volatility that contributes relative to its midpoint allocation. If you look at the other asset class tools that you have, they contribute much less volatility, especially relative to their planned allocation. This is a totally normal result, and that's why we pay so much attention to equity beta and correlation, is because it does drive risk.
You know, we work for you. We work well with John and his staff and Dave. But one of the questions you could ask is the strategy too conservative? Are you, that's a legitimate question. Our answer to that would be no, absolutely not. It's working. And it's working without taking big bets, and without risking a great deal of volatility. Volatility is the enemy of compound return. But it's a fair question for a trustee to ask when you see a strategy that shapes up as being, we're going to not try to capture all and then some of the upside. We're going to make sure that we capture a lot less of the downside. And you can see it in all the statistics that we've talked about. It's actually woven through the investment strategy and implementation that your staff has put together. So fair question, but our response to you, knowing that you're our boss, is no, this is a good strategy for a pension plan that is still underfunded and is cash flow negative.
And the last point I'll make is on the following page, page 27. We've talked a lot about risk and return and various measures surrounding that. But again, as we go into asset allocation season, the other thing we have to take into account is how much are the asset class tools that we're using, how correlated are they to each other? Are we just adding more of the same thing and going to be subject to the movement of overly subject to the movement of one particular market? And this is a good reminder. If you just look at the left-hand column, domestic equity, and this is the correlation, actual correlation over the last 5 years. And
with your most volatile asset and your
Yes.
largest single allocation.
so when you look down that column, of course, domestic equity has a correlation to itself of 1. It's perfect. It's the same asset class. It has a correlation to international equity that's high as well. That's why we say, you know, it is nice to have exposure to stock markets outside of the United States, but they do have a similar movement over time, although it's not perfect, so it helps a bit. Core fixed income helps much more. It tends to move very differently. It really, most of its return is on the back of the yield that it pays. Non-core fixed income tends to be when you include high yield and convertible bonds, those tend to have a higher relationship to equities. And that's something we keep track of as we go into asset allocation season. Real assets, as we look at those, it depends on what kind of asset it is, but they do have a nice lower correlation to traditional equities. Real estate is the rock star here in terms of having a good long-term return track record and expected return track record, and very little correlation to the equity market, almost no correlation. to
And
the
with
equity
fixed
market.
income, which is really interesting
Mhm.
because it's your second largest
Yeah.
allocation. The only number on here that is suspect is that very low correlation to domestic equity for private investments.
Mhm.
That is an accounting timing mismatch that drives much of that. And so you don't want to lean too heavily on that. As a diversifier, it's really more an asset allocation that you count on for long-term growth of the portfolio.
And we take that into account in our asset allocation work. We don't assume that it's going to have this very low number. Because at the end of the day, private equity is equity. And we think in the long term will behave like it, but the actual return experience has been very low.
And this is really
Low
geeky, but
correlation.
the reason that it looks so low in this chart is this chart uses monthly periodicity. That is, we're looking at variations month to month to month to month to month, which accentuates the accounting stability of private equity. If we were to look at it over year to year to year to year, we would lose something in terms of the picture of actual volatility of the portfolio, but some of this advantage for private equity would disappear. In terms of its correlation benefits, it has many other positive aspects.
Jim, let's take the flip side of what you raised a minute ago about being too conservative. So if we look at these correlations, you know, there's a distribution of how of those for each single item. And as I asked you last time, I mean, the correlations in one of the last downturns, everyone was like, everything's correlated, or that's what I heard. I wasn't that active at the time to look.
I've heard it 1,000 times.
Exactly. So when you look at it, and I know that we're built to diversify, so that to protect as much as possible. But you raised an interesting question, which was, are you being too conservative? So let's take a look at the other side. Do you think that how well protected are we with a, let's say, things go terrible in the Middle East, interest rates go, inflation goes crazy, market tanks, correlations. What is our what, I think it's proven in the past because we have, I think, outperformed as you were pointing out
In down
our,
markets.
in down markets. But what would your analysis be there?
You would have to specify a more, or you would have to have a scenario that was far
Yes.
more specified, because something goes wrong in the Middle East. It doesn't tell you anything about what exactly happens to US equity, international equity, interest rates. I mean, when we have been done on a project basis, lots and lots of scenario testing.
Yes.
That's a whole nother kettle of fish. It's very time consuming and very scenario definitional intensive. But it depends too on where else you put the money in these scenarios. So for example, if you move a whole lot of money out of US equity and say, I want to dampen the volatility of the portfolio, and I put it into international equity, we haven't gained anything. I mean, you've gained marginally. If you put it into real estate or cash or something like that, you can materially change it. When we do asset allocation, you'll get at least a flavor of that as you move across portfolios and the allocations change. You will see downside risk change. It will do a Monte Carlo analysis over 1, 5, and 10 years, and you'll see the numbers of the downside risk change, which will be a partial answer to your question, but it won't be scenario based. It'll be based on the asset allocation template and the embedded assumptions about volatility for each of the portfolio or each of the asset classes and their correlation with the other asset classes.
But it also, in looking at those extreme environments that you're referring to, that model also just throws out the window that the bell-shaped curve that all of us think about is a complexity of just traditional asset allocation without this stress testing. The reason why we always do the Monte Carlo is accompanying that asset allocation study is because it does show you what the left tails can look like. For all asset classes that have left tail, we call it non-normal distribution behavior. For all of them that do, they're reflected in our Monte Carlo work. And so you'll be able to see for various portfolios what we believe the first through fifth percentile would look like, the worst case markets. The GFC was not a first percentile event. It wasn't the worst of the worst.
Yeah, believe it or not.
As bad as it felt, it was between
That's
a
crazy.
third and a fifth percentile event, probably third. But we will definitely go through some of those results later
But-
this year.
But I can predict that when you see the 1 year and 5 year downside possibility for the fifth percentile or the first percentile, that's kind of the worst of the worst, it will be big enough that if you imagined yourself sitting through it, you probably would feel, I don't know that I want to go risk anymore, if that's the thrust of your question about flipping my comment.
Yeah, no, I liked what you'd said, and the answer, as you pointed out, is that we have participated so well in avoiding the downside comparison. Comparatively to others.
And not giving up that much on the downside to do it.
Let me tell you how I think about it anyways, I guess, because at the end of the day, correlations, whatever, they change over time. GFC, they all went to one kind of, at least for a while, so they did in COVID as well. For me, it always comes back to, and this is mostly around the pension plan, but with our other portfolios as well. Everything we have is very long term, basically, right? So what do I care about most? I care about being able to pay benefits. Okay, I have to pay benefits every month, and it doesn't matter what the economic environment and investment environment looks like. So at the end of the day, what I want to be able to do is I want to be able to pay benefits for an extended period of time without tapping assets that I really don't want to have to tap. So if the markets are getting killed and we're down 50% in domestic equities, I don't really want to have to sell domestic equities in order to pay the bills, as it were. And so the way I tend to think about that is, okay, what's our cash? Which typically, we're looking ahead, we have the capability to say, well, we kind of know what our benefit payments are gonna be. We tend to know with a little less certainty, but some range, what are my capital calls going to be from all of my illiquid asset classes, okay? So I'm adding all of those things up and saying, what do I need?
How
on a
many
monthly
days cash
basis?
do you keep?
So with 2% cash, we could probably, if I were to run it down to nothing, I could probably pay benefits for 6 months.
Oh, great.
Most of the time. Now it depends on sort of what the capital call environment is, and sometimes those run counter, right? So we get into a bad environment and all of a sudden they want
That's
to make
right.
capital calls because they see deals out there. So that also can be,
Though we didn't see that in the
Flexible.
GFC and we.
we don't a lot of
we
times,
see that
they
in the
get as
real
scared,
estate because
they get as
markets
scared as
freeze up.
everybody else, right? Absolutely.
That's
So,
great.
you know, I'm looking at cash first.
That seems,
I'm looking
that seems
at, you
pretty.
know, can I walk over to John Ramasco's office, tap him on the shoulder, how much do I have in treasuries? You know, rough numbers, I've probably got 600 million in treasuries, so I've got another, you know, multiple months. So most of the time, if I kind of look around, real estate's spinning off cash, no matter what, I'm getting the lease payments. You know, rough back of the envelope, we probably have 18 months to 2 years of runway before we really get into spaces where, okay, now I gotta make some real hard choices. And frankly, that just doesn't typically happen. I mean, even in the GFC, yeah, it feels
Yeah.
really
And the hard
uncomfortable.
choices
and I'm
are not
making-
to pay benefits. The hard choices are to sell some things you
Can I-
prefer not to.
Right, and do I wanna step back in on something
Yeah,
else?
great.
and-
That's
and
good
all of that.
analysis.
So that's more how I think. of it.
This is an important point that John raises, that, you know, you can't look at these numbers and abstract them away from who you are and what you have to do in your current circumstances. There are situations where value at risk, short-term value at risk matters a lot. I'll give you an example, a hedge fund that can literally go out of business because it's leveraged if it has a very severe short-term downtick. Maybe because correlations go to 1, they only last that way for a month, but it can kill that kind of fund. An insurance company that has a very small surplus. If in the short run, that surplus disappears, the regulators can shut them down. So they are courting enterprise risk. You don't have either one of those risks. There are pension plans that are like this, but they're severely mature. They have 26 active members to 500 retirees drawing benefits. So they have huge cash outflows. And they are very sensitive to 1 month downticks. But correlations can go to 1, but not for very long, and certainly not in any of the time frame that matters to John in terms of executing his mission. So I'll stop there.
All right, any other questions for RVK?
Boy, we got deep into the Geekville there, didn't we? Sorry about that.
That was good, thank you.
As long as somebody can understand what you're talking.
So the full document went out to your smart rooms. It didn't go out in the mail packet. So we've reprogrammed the smart rooms that you will get an email anytime a document is loaded into your individual smart rooms.
You just need it's a password.
It's, yeah, whatever you pick.
It's like the HR doc.
What's your password, Cindy?
That's a good question because I don't remember.
Apologies about the
I had to use my
confusion.
smart room to fire stuff.
But you send an email that says you sent it, and then you just have to go to your smart room.
Didn't have your password.
All right, tab 8, investment update.
We think Christopher, because some of us are going to take away.
Do we want a break? We can do 5 minutes. Let's do 5 minutes and come back. Yeah, babe.
I'm sorry, I got carried away.
Life, the metaphors, this
It happens.
Starting talking
Go on here. Maggie's ready?
Not having a fourth.
Ready?
No, you're not.
We're ready. Go ahead.
All right, thank you, Mr. Chairman, members of the board. We are on tab 8. We'll kick it off here with the economic environment on page 4. So similar to Jim and Becky's comments, you know, I guess we've had a lot of stuff go on in the first quarter and since then. But overall, you know, it's kind of been minimal negative impacts overall in the data from the war in Iran and the closure of the Strait of Hormuz, which has sort of been obviously the top news flow if you've missed it by any chance. Although, you know, consumer sentiment seems to have gotten a little bit more negative, it really hasn't shown up in spending or lower job numbers at this point. First quarter earnings were very good, driven largely by the AI CapEx boom that we've been seeing. And overall, the US economy and markets in general have been really surprisingly resilient, much more so than I probably would have expected, and I think probably a lot of people. I won't read through all of these. Few other things to point out, as mentioned, like job growth in April, we held steady at 4.3% unemployment, so still very low. Non-farm payrolls jumped up a bit at 115,000 in April. So kind of still ticking along there. Retail sales did okay in April. Inflation's probably the biggest call out. It was up a little bit. Core CPI was up to 2.8% in April. So moving a little bit further away from the Fed's target, as Jim kind of talked about. Regular CPI, which includes food and energy, was up to 3.8% in April. So for those of us that don't just get to focus on core CPI and still have to put gas in the tank and eat food, probably feeling it at least a little bit. Other than that,
Your data is of the end of March though, right?
on the page, it's into March. I just was mentioning some of the April numbers that have come out since we've made the board book. That's the problem with having these meetings, is I always have to put all the data in here and get it out the door, and then
Yeah.
a month later, we have the meeting and lots has changed.
Yeah.
Slide 5. Just a chart here of oil prices versus the Strait of Hormuz tanker activity. This is as of the end of April this year. This chart looks almost exactly the same if you go run it today. Not much has changed. If anything, oil's just a little, maybe a hair higher. I think Brent closed about 111 a barrel yesterday. WTI was at 104. Still not much activity through the strait at this point. Slide 6. You know, this was one from JP Morgan Guide to the Markets. A little dated here because this is the end of March. This is March 31st data, showing gas prices over on the left. So the orange line there, 2026, we're currently up to about 450, a little over 450 for the average price of unleaded gas at this point. So a bit higher than what we're showing here. But the real point here is that, you know, the impact here falls most heavily on the kind of lower and middle income households, because they're spending a greater portion of their income overall on energy costs. And you know, food is probably not far behind, as Jim mentioned. You know, energy tends to find a way to trickle into inflation, particularly in those types of things where you've got to ship it around the country and all of that. And there are costs associated with that. So, but thus far, we haven't seen, you know, a big pullback there, but the higher it goes, the longer it drags on, the more likely it is that we start to see some people having to change their purchasing behavior a little bit, at least at the lower end of the spectrum.
Gas really that high in 2022?
It was, which is kind of interesting,
No.
because, you know, that is a good corollary in the idea that it also did not really have an impact because it didn't last for a highly extended period of time. This could be similar, and I think that's somewhat where the market has gone with it at this point. But TBD.
We do have a very short memory on things.
Slide 7, tariffs feels like an afterthought at this point for the most part, but has certainly been in the news over the last year or so. You can all harken back to Liberation Day a year or so ago, where initial rates came out very high, at least the proposed rates. Ultimately, we settled a bit lower with the IEPA tariffs. Those kind of got shot down. The administration moved more to the Section 122 tariffs, so at about 10%. Recently here earlier in May on the 7th, the US Court of International Trade deemed the Section 122 tariffs illegal. The administration, of course, is looking for other avenues, and there are other avenues to continue that. The overall point here is that, you know, with all the tariff talks, it certainly is much higher. They're certainly much higher than where we were prior to all of this, but not nearly as bad as what the market would have initially feared, at least. So again, we kind of continue to roll on. Slide 8. I just like this one because it always strikes me. Jason has talked about this a bunch. He covered a lot of it in the deep dive in April, but it's another good representation of sort of the change in stock leadership of the top 10 companies within the S&P 500 over time. And, you know, if you're looking kind of out towards the left, you can see none of those names are the same as what they are now. And in fact, where we're at more recently here, they're almost all technology names with the exception of kind of JP Morgan and Berkshire Hathaway. And so those big tech names, I mean, we all know that they've dominated, but it is striking to see this kind of over the decades and see how things have changed and morphed over time.
And yet we still have a Walmart and you can still buy Coke.
We absolutely
Merck is a
do.
Big deal and
It's-
IBM's still around. and-
It's not like any of these names have disappeared. I think most of them are household names. Maybe if you're looking all the way at the left and you look at Kodak or something, you might go,
Yeah,
probably not what it used to be, but
it doesn't even exist, does it?
I
Kodak?
believe they're still around,
Yeah.
but much smaller.
One real quick factoid
Yeah.
for a cocktail party conversation. The market cap of NVIDIA is the same size as Germany's GDP.
Say that again?
The market cap of NVIDIA is the same size as Germany's GDP for the entire country. Apple is about like India.
If we're doing cocktail party, I will also say that the size of Montana is about the size of Germany, but with a lot less people.
Yes, yes.
5 million versus 1 million.
Exactly.
And what is
And
that?
a lot more
I mean, I've
bears.
heard of NVIDIA, but I've not researched it. What are they? What do they do that I would recognize?
They make chips.
Chips
Yeah,
for AI.
it probably says that on this computer somewhere.
It might.
Hmm.
Okay, any questions about the economic environment?
I
before
like
move
that.
on?
I like that one, by the way.
All right, slide 9, jumping into the broader assets here. So total assets under management, a little over 30 billion. Today, we are sitting at just under 32 billion. Knock on wood. Right, maintains. So as I think Jim or Becky pointed out, you know, huge rally here since the end of the first quarter. So it's been great. Slide 10, participants, no real big changes here. I think same as you see most quarters, pension fund, obviously the big one here. Other ones are kind of as they have been. Slide 11, assets by pool type. Again, no real big change here. I'd say if anything, the surprise here for me, I think I've mentioned it before, is just kind of that STIP has continued to hold up and be as big as it has been. Still well over 8 billion, and kind of thought it would come back down a little bit more than it has, but hey, we'll take it. Slide 12, moving into pension more specifically, well within all of our approved asset class ranges here. You can kind of see here the cash that I was talking about earlier, 1.5% cash versus I think the 0.5% or so that RBK was showing on the slide there. That's just that 1% that generally sits at the TRS and PDRS for their benefits. Slide 13, pension asset allocation. Again, nothing to point out here in terms of big changes, well diversified. See this all the time. We are over 17 billion at this point as well in pension. As of yesterday, I guess I should say. Slide 14, pension net performance. Good performance here over a long period of time. Again, the dollar value add over time of increase in value and cash and things from the portfolio is far outstripped the net cash need of what we've needed to pay benefits. So we continue to grow the portfolio through time, which is what we would love to see. 1 year can be a little bit more variable. Obviously, that sort of depends, but most recently it's been real strong. Slide.
Does that net cash need pretty stable?
It's pretty stable. Yeah, it's runs roughly 50 million a month at this point. It has been ticking up over the last few years, and I forget which slide I showed that on. When we talk about
It's gone up from about 3.25 to
Yeah.
about 4.5, 4. And then the last 2 years, it's stabilized.
it's starting to stabilize. So what you're basically seeing is kind of that wave of baby boomer retirements, and then it kind of comes back down the other side. And
At 3% GABA.
at 3%,
That's the kicker.
that's the kicker.
But
I
the
think-
baby boomers is leveling off.
It's starting to level off, and I think it's in about 2029 when we look at those numbers, that it starts to sort of roll over and come back down a little bit.
So that's
So our net cash
in
should
29 as well,
start to
when,
taper off a bit,
3% reserve.
dramatically.
collecting
I wouldn't say it's when they're collecting their pension. I'd say it's when some of them are rolling off of their pension.
As in
For
dying.
multiple reasons.
Yes.
They die.
Benefit selection's the other.
What did you say?
Benefit selection,
Oh.
10-year versus lifetime.
Slide 15, performance here. Good performance over all the longer timeframes. I always tell you to, look at the longer timeframes. That's what matters the most. Fiscal year to date here, plugging along, as of yesterday, sitting at a little bit over 11%. So again, been a good run here the last couple of months. We hope that it holds on through the end of the.
Right, I'm not hoping for anything. I know we're getting close to fiscal year end when Director Graham calls me on a daily basis saying, where are we at?
He calls you, Bill calls you, you come and yell at me.
Not that I have the executive dashboard now I'll be able to see for myself.
Vicious cycle, right? For the reason we needed it. All right, any questions on pension before I move on? Okay, seeing none. Assets under management excluding cap. See the wheel chart here on slide 16. Again, no changes other than I think, if memory serves, the Go distribution fund, Go pension fund, those are bigger numbers than they were because we've gotten all that cash in there. So I think maybe they're showing up there's more so than they were prior, but
And those are just a result of last session, right?
correct. Yes.
But is there new money going in or just earnings that? going?
So
It's,
for the
it's,
current biennium, there is new money going in from earnings next and then anything, there's a waterfall, as we talked about before,
Yeah.
things in excess of HJ2. Next biennium, we start taking the volatile revenue, which is the capital gains and those highly volatile revenue streams that they want to smooth out over the longer term.
Okay.
But this biennium, not a lot. Next biennium, it really kicks in.
Slide 17, short-term investment pool STIP. Doing well here, everything's ticking along. STIP yield as of yesterday was 3.86%. Probably 3.86, yeah. Yep. Probably the biggest thing here is rate cuts appear much less likely than what they did just a short time ago. So
So do you anticipate this?
that inflation is moving away from Fed targets.
Do you anticipate the STIP balance is gonna maintain around that $8 billion long term?
I don't know, but it has been, we would have expected it to come down a bit more than it did, but incoming revenues and things have been strong, and so it has remained.
It was a very good income tax year for the state. They're about 200, yeah, they're about 200 million above the official projections. And we'll start to, I mean, I think it's gonna stay that way through the summer. You'll have one big OPI payment in May, June. But then you've also got property tax revenues starting to come in May, so. I think it's gonna be a little higher, a little longer.
So it's gonna maintain it.
I would, in that range, yeah. I mean, we might get below 8 for a little bit, but once you start getting estimated payments and November property taxes, it'll probably tip back up a little bit.
All right, slide 18. STIP pool performance. Like I said, we're at 3.86% right now. Look good versus the benchmark here across pretty much all the time frames, or at least close to or a little above. Questions about STIP before I move to trust funds? Okay, seeing none, slide 19, trust funds investment pool. Again, well within all of our approved asset class ranges. No real big changes here. We did see private credit tick up a little bit more slowly, but slowly we're getting a little more money in the ground there for trust funds. Expect that to continue. I think we're above 4 billion in trust funds for the first time that we've reported to the board at any rate. So that's new. Other than that, not much to add there, I don't think. Slide 20. Trust funds performance. Again, I would point you to the bottom of this page where it says yield. The trust funds investment pool yield at 4.17% for the 1 year. You will remember that, of course, all the participants in trust funds, they're generally spending what they earn for whatever program it is that they have. So they like it when their earnings go up, which they've been going up as yields have come up off the floor recent years, and probably a little bit further to go there. Yield to worst on the fixed income portion of the portfolio is around 4.5. So would expect that to kind of continue to move towards that level over time. Questions about trust funds? Good.
Because it kind of tells you, well, it tells you what's happening with all the funds, why they're going up, and you're using, and
Our Moscow is going to be really excited. about
pictures are really. Okay.
Slide 21, state fund. Again, well within all of our approved asset class ranges here. Continue to add private credit here as well, similar to trust fund. Mentioned earlier, John and I will be presenting to state fund finance in early June, as we usually do each year. We've been meeting quarterly with the staff, and I think everything's going well there.
Question, John. So earlier we talked about coming back and adjusting the real assets class thing. So I see that they're up pushing at the top of the range here
For state fund.
for state fund. So if you would just,
Yeah, we
Yeah.
we probably wouldn't come back, and that. If I remember, I think the range, I can't remember if it's 4 or 6 for state fund off the top of my head, so it looks a little closer than it actually is
okay.
within this one, but we wouldn't be coming back on state fund, it would just be for trust fund.
Okay.
State fund performance on slide 22. again, pretty good performance across all the longer timeframes here. We're under fiscal year to date, but no big worry there. And, any other questions on state fund? All right. So finally, on slide 23, we've already talked about it, but you know, closure of the Strait of Hormuz has been the big news most recently. Certainly significant volatility in the market, hard to get a gauge on things. I would say high level. We've been a little cautious as things have run, have been pretty judicious about at least bringing us kind of back down to the midpoint when we've had the strong equity runs here. It just feels a little overdone to me in some ways, but you know, keeps rolling nonetheless. And the optimism around AI persists, and you know, you can't undersell that either. So we're just kind of sticking to our midpoints for the most part here. Projects and things, again, talked about it a bit, but been working real hard on the defined contribution deferred comp stuff. I think we're in good shape there. I will not sleep well until we get to probably July, at least July 3rd, if not July 10th or so, before I feel like, you know, okay, it all went well. But, you know, from everything I know at this point in time, we're in good shape. We've been having regular meetings with Empower, with State Street, with the managers, making sure that everybody's on the same page, getting contracts signed, all those good things, and that we're gonna make all the cash flows happen as they should.
Oh, you were gone.
What did you do?
Last week's call, we had a problem with Good Friday. Surprise, surprise.
Yeah,
Okay, aware. So this TA for STIP, we will not be doing STIP transactions on Good Friday going forward. It's a market holiday, but not a bank holiday, and it has screwed up every year, and it's a giant pain. This DC 457 conversion, one group of individuals would be able to trade, one group of individuals would not. So we just said we're shutting down the TA on Good Friday. It eliminates that risk. And now if you trade on Thursday, you'll settle on Monday. Done. So at least 8-year pain has been resolved out of this process.
it moves us towards market convention, I would say.
Yeah.
Anyways, so it's okay. We talked a lot about the AI stuff, so I won't go into any more there. We've moved a lot of our internal communications to more of the secure platforms. Tell you offline about the details there if you care, but I think an important process given all the things that go on in the world today. Starting our asset allocation process here, we'll be going to Boise in August. And we talked about all the new hires and things. Ethan Kittle passed his CFA, so level 3. So he is now a CFA. Say, well, not as fast as you can do it, I guess, record time. So he did quite well. And I think he's happy to be done. Who wouldn't be?
Yeah.
And we already talked about Mr. Carpenter and his CIPM, so good. I think that's about it from me. Any other questions before I turn it over to Aaron? Okay.
Good afternoon, Mr. Chair, members of the board. Aaron Carpenter, Director of Investment Operations. I'll run through macro attribution here. Starting with strategic asset allocation, all benchmarks except real estate provided positive contributions to the pensions policy neutral 11.31% return. Moving on to tactical asset allocation, about 474 million of equity asset classes and 91 million of fixed income and cash asset classes were sold during the last year to fund the pensions net cash need of 565 million. In aggregate, this overweighting, underweighting relative to their benchmarks decreased the pensions portfolio return by about 42 basis points. Again, style selection, if there's any questions, you go ahead and ask them, but there's not big changes here every quarter. I'll move down to manager selection, and really the one thing I would point out here, because there hasn't been huge moves here, except in one asset class since last quarter. And I would point out real assets, which underperformed by 57 basis points. And this is really due to them having public infrastructures and commodities, public commodities benchmarks that really ripped with everything going on with Iran and the Strait of Hormuz. So that one did jump up pretty significantly, but should not be surprising given that we're, again, benchmarking private assets versus public there. That's all I really have today. So unless there's any questions, I'll pass it off to Jason.
Thanks, Aaron.
Afternoon, Mr. Chairman, members of the board. I'd like to start by touching on one theme that you'll hear in domestic equities and international equities. And it revolves around the idea of, is it a stock market? Is it a market of stocks? Try to explain what I mean. So we see the stock market's up. What does that mean? Does it mean all stocks are up? Does it mean all stocks are up equally? Or are there divergences among stocks, among regions, among sectors, or even within sectors? And we've seen some interesting divergences in the first quarter and over the last year. I'll try to hit on a few of those. With that, I'll start with domestic equities on page 27. So after the S&P's recent all-time highs, it may seem like old news, but yes, in the first quarter, US stocks had their worst quarterly performance since 2022. And I'd point to two major factors driving the sell-off. First, obviously, geopolitics, and second would be the drop in technology stocks. I break that down into two parts. First was partly due to questions about the sustainability of spending on AI by what are known as the hyperscalers. These are the big tech companies that are spending hundreds of billions of dollars on AI, and also some skepticism around their ability to turn that spending into future revenue. And two big losses in software stocks due to fears from disruption by AI. And with that dynamic, value stocks, which include energy and materials, outperformed the tech-heavy growth stocks in the first quarter. In fact, value stocks posted positive returns in the first quarter. In addition, small caps outperformed in not just the first quarter, but over the last year. And if we look at returns over the last year, AI optimism drove strong returns in the technology sector, but not all stocks in technology are equal. So stocks seen as beneficiaries, like semiconductor stocks, have done amazingly well for the last year. Stocks seen as being under threat from AI, like software stocks, suffered steep losses. So there's been a huge difference of returns within technology sector over the last year. And while tech did very well over the last 12 months with rising oil prices, energy was actually the top performing sector in the S&P 500. Page 28, upper left-hand corner shows our exposures by sector. As we discussed in the recent asset class review, we're all passive, so our differences between the benchmark are very slight, and they mostly come from our overweight to small caps, which you see in the bottom right-hand corner. We've reduced that overweight slightly in the second quarter, but it's a very slight adjustment. Page 29.
So Jason, I have a question. Do you make the decision on overweighting or underweighting large cap, small cap, or?
Yeah, so for a long time, it's been kind of a structural overweight, small caps. And we talked about that a little bit in the asset class review, the reasons for that. But we'll manage it, and we can do that through our small cap index fund or through ETFs.
Okay.
So page 29, as would be expected, US stock valuations dropped in the first quarter. And so did the concentration among the top 10 largest stocks in the S&P 500, which was under 40% at the end of the first quarter, but it's now back over 40%. We focus a lot on the price part of the PE ratio. One reason that US stocks have been so resilient is the E in the PE, that's the earnings. And earnings growth is expected to be as high as 20% or so this year, with a lot of that coming from the tech sector. Now, does the earnings outlook change if higher oil prices lead to slower economic growth? We'll see. At the moment, strong earnings growth has been supportive of US stocks, even though the earnings growth has been concentrated in a relatively small number of stocks. Any questions about domestic equities?
So the PE right now, if I'm reading this correctly, is around 25.5.
That is the trailing PE. Okay. And I usually in the commentary, reference the forward PE, so that's the projected next price, current price for the projected next 12 months, which is a little bit lower. Okay. Moving to international equity on page 30. So international stocks lagged US stocks in the first quarter, although they did end up with a large gap over US stocks for last year. And the general theme this year has been energy exporters and emerging market technology companies have done well, while countries that are energy importers have suffered. International value stocks outperformed growth, partly due to the rally in energy. And emerging markets has outperformed developed in the first quarter and over the last year. And if we dig deeper over the last year, the main difference is in technology exposure. The EM index has a lot more technology exposure, but even that doesn't fully explain the outperformance of EM. If we dig even deeper into technology sector, a lot of EM's outperformance for the last year really boils down to three Asian tech stocks. And the dynamic that we saw in the US, where semiconductor stocks did great, software stocks did poorly, that was even more pronounced in international equities. And two, after having experienced a period where international stocks were helped by a weaker dollar, the dollar strengthened in the first quarter, which created a headwind in international stock returns. Page 31, an upper left-hand corner is the positioning in emerging markets versus developed. We're slightly overweight, and that's due to the positioning of our active managers. A few years ago, we were underweight. This is something that we don't choose to manage ourselves. Again, it's the aggregate positioning of the managers and our index funds. And the same with the overweight to small caps in the bottom left. We leave that to our managers. It's not something we've chosen to adjust ourselves. In the upper right-hand corner, you see the sector exposure differences are small, but you'll notice we're a little bit overweight technology, which is different from our position in US equities. We're very slightly underweight, and we're a little bit overweight in energy. And at the bottom right shows our split between active and passive. Again, this is heavier in passive than what we would normally expect due to the manager termination we had last year. 42. As in the US, valuations dropped in the first quarter for international equities. And we've seen how the outperformance of international equities over the last year or so has narrowed the valuation gap, which now stands at about a 31% discount to US equities. I had mentioned how strong earnings growth had supported US stocks. Most expectations are for double-digit earnings growth for international stocks, maybe not quite as strong as in the US, not quite as much in tech, international, but stronger earnings growth, closer to 20% is expected for emerging market stocks. Any questions about international equities? Moving to non-core fixed income on page 33. As with the other public markets asset classes, non-core fixed income experienced a downturn in the first quarter, but a very modest one compared to equities. Emerging markets debt and convertibles, which were the strongest performers over the last year, suffered larger losses than US high yield and preferreds in the first quarter. That has reversed some here in the second quarter. But returns around 9% for non-core fixed income and cap are solid. And I'll note that all of our managers outperformed their respective benchmarks over the last year, which is nice. That doesn't always happen. 34. Sector exposures on the left. As we explained in the past, our exposure to non-high yield strategies gives us different sector exposures than the asset class benchmark. The same is true for credit rating exposures compared to the asset class benchmark up in the upper right-hand corner. And that preferreds and EMD have significant investment grade exposure. And the bottom right shows our exposure strategy. We took a very small amount out of high yield late last quarter when high yield has been holding up better than equities, but it was a small one. 35. High yield spreads did widen about 50 basis points in the quarter. They had widened about 85 basis points from their January lows to their highs in late March. Continued to tighten here in the second quarter, and we're now lower than where we were just before the Iran conflict began. And with the spread widening, absolute yields have increased. At the end of the first quarter, we're back up in the mid 7% range. Any questions about non-core fixed income or domestic international equities? Thank you.
Thanks, Jason.
All right. Maybe just by the skin of my teeth. All right, hi, everyone, I'm back. Covering off real estate on page 36. We've got what we saw earlier today, ownership, dollar value add and performance by pension trust and state. In a number of bullet points, which I won't necessarily run you through verbatim, but I think the key takeaway with real estate is I think we're in a cautious recovery. It's very fragmented by property type and market. Debt is available, widely available, in fact, for the right deals. We are no longer living in a zero interest rate environment. We're not seeing massive cap rate compression. So the name of the game is going to be operational value add, growing net income, ensuring probabilities of renewal with your tenants, and really getting hands-on with your assets. And just as a reminder, that's really where our portfolio is focused, with people who are deeply entrenched with their properties, with their tenants, or vertically integrated operators versus allocating capital and decisions from ivory towers in New York. We have a little bit of that. I don't want to lead you astray, but nevertheless, philosophically, operational focus is really where our portfolio is at. So with that, I'll open it to questions. Otherwise, we'll roll on through. Next page, upper left, you've got our IPS strategic asset allocations, well within constraints, property diversification. Upper right, you've got our private real estate, cash flow and net asset value behavior through time. REITs are not included in this. Happy to address any specifics. Seeing none, we come to our real estate valuation page, where I've provided you with Green Street's valuation, their commercial property price index in the table above, and then a linear format of price behavior through time as of April. I mean, basically, I'll draw your attention to the middle column, the past 12 months. And as we've discussed already, there's recovery happening here. Prices are stabilizing. There's a little bit of underlying distress that remains. Again, it's property specific, it's debt specific, it's market specific. It's going to be a fragmented, lumpy recovery. But we're on the upward swing, slowly.
It's perhaps the best report you've given in 3 years.
Trust me, I know. But like everything, it's cyclical. But again, I will just, it's funny, after I got out of the real estate asset class review, I ran a chart for CPI against the ODCE, which is the core fund index, and MPI, which is a broader index of, I think, maybe 9,000 properties. And I ran a compounded annual growth rate through time since inception for all of those indices, in real estate outperforms, whether you're super unlevered kind of core real estate or levered core real estate. We beat inflation over long periods of time, which is why I think it's super important for us to be involved with managers that are super active, operationally oriented, and we can manage and hold real estate and avoid the cost of buying and selling over and over again. We can avoid taking this blind pool reinvestment risk over and over again. And so I think, to Jim's point earlier, we're making decisions that will last us and are positioning us over many years, decades, in fact. And I really think this is the right way to do it. I mean, if you think about, I think about billionaires on planet Earth, they inherited it. They're a titan of industry. They're a financial investment wizard. They invented something, or they're real estate magnates. And they have multiple hundred millions, billions of dollars worth of real estate that they've owned for decades, generations, in fact. They've reduced their cost basis to zero essentially by, taking dividends out as values have increased, and they've relevered and paid down and increased their rents all along the way. And they're collecting giant coupons from their cash flowing real estate. And that's the exact same type of position I'm trying to put us in. If there aren't any questions, we'll roll on to new commitments. There haven't been any since last we met. We will have some for you in August, so stay tuned. Any questions? Real assets, upper left, ownership by pension trust state, dollar value add, performance, and some bullet points here. If we think oil and gas, some of the big things, the US is a net exporter of oil and gas right now. We've seen exports go up and to the right recently, given what's happening in the world. The UAE just left OPEC. That's pretty big news. And I'm happy to address any of these other specific bullet points, but those are kind of the big headlines. Rail leasing is doing great. Aggregates are doing great. Those are all big positions within the portfolio. Lease renewals are outpacing inflation. Our royalty streams are outpacing inflation. Pricing at the actual aggregate level is outpacing inflation handily. In some cases, 2, 3, 4, 5%. Happy to answer any specifics. Otherwise, we'll roll to characteristics, where again, we see the investment policy constraints. We're well within domestic and international geographic exposure.
Who's the analyst who's primarily focused on real assets?
It's myself and Rob. We also cover real estate.
Yeah.
We're partners in crime on real estate and real assets. You've got our cash flow and NAV behavior through time here. Again, just as a reminder, this is just private investments. This does not include our public MLP exposure. On page 42, we've got our the real asset valuation slides, still representing oil and gas. Oil's blue in the top, gas is yellow. And then we have some US South pine saw, chip and saw, timber specific price action. Again, geopolitics, name of the game here in oil and gas. Timber prices have been generally stable with, market specific effects influencing them across the breadbasket, Pacific Northwest, et cetera. All of our timber exposure is domestic, as a reminder. Happy to answer any questions.
What is the 1-year benchmark?
Or
It says real asset ownership breakdown on it. It says, what is the benchmark for the real assets then?
for real assets, it's market weighted, the ACWI, all producers, commodities, infrastructure. Oh, and tips.
I think we took the tips one out.
Sorry,
No, we did. I think it's just weighted.
I have it written.
You're right.
Yeah, that's right.
Just don't have much tips.
Yeah, tips, commodities, and infrastructure, all public. And that, by the way, is the same benchmark for the 5-year, the 3-year, et cetera. And will be the same when the 10-year number populates. Benchmarks don't change without board approval. On the new commitments page, no new commitments to report. We'll have some for you in August, so stay tuned. Any questions? I'm happy to address. Thank you for your time.
Thanks, Ethan.
Yeah, thank you.
I'm gonna say thanks, Ethan, but he didn't introduce me. Good afternoon.
You know who you are.
He knows who I am, yes. Hopefully you know by now. Thomas Winkler, Director of Private Investments. Good afternoon. Spending some time. I'll kick it off on page 44. Private investments, ownership breakdown and performance. Ownership breakdown, for once, we actually have a change here. As you now can see, we committed to private credit in state funds and trust funds. We're 1 year in with our first commitment there. It's about $30 million in exposure right now. So that's the counts towards the 2.8 billion total portfolio in private investments. Long-term portfolio is in good shape. Performance is solid within expectations. Don't have to highlight the long-term performance. One point I wanted to make, we have seen a slowdown in distributions, if you remember talking about it in our October deep dive in private investments, similar to all of our other peers. That doesn't mean that we don't see any distributions by any means, but it clearly has slowed down. Our private credit allocation is really a mitigant here, so it does help with that. And that goes back to the fairly conservative construction of the private investments portfolio. We've spoken at length today about conservative portfolio constructions overall. Just wanted to remind the board, it is a more conservative approach in a fairly risky asset class. With that, we're meaning lower leverage levels across our GPs, our portfolio companies. We're trying to buy right. I believe Ethan had mentioned that earlier in the real estate review as well. Focusing on GPs that are not really clean just because valuations are high. We're trying to buy right. With that should come a better exit environment for our managers when the time comes. Another point in the top right-hand side chart, you see the dollar value add. I just noticed that actually while we were going through the overall pension plan, the dollar value add for the total pension was, I believe, 5 billion for the year. 1 billion of that came from the private portfolio. So we're clearly adding some value here, even though we're not making up 20% of the portfolio, but we have added 20%. Any questions on that slide specifically? Happy to address. I will move on to 45. Characteristics breakdown of the strategy geographically. No big changes here as I highlight every single quarter. The portfolio doesn't move around a whole lot. We're well within our allocated ranges here. And just one point, the buyout segment, you heard me talk about, the lower middle market focus, the small buyout focus. Over 70% of our buyout exposure is actually in small cap or smaller funds. With that, we mean funds well below $1 billion in size, sometimes even below 500 million. So very, very different from your typical private equity market environment. Any questions on that particular? Seeing none, I'll move over to our market overview valuations. Again, you're familiar with the chart on the left. The deal activity, you heard me say this last quarter, 2025, certainly a record year in terms of deal activity, money put into the system and deals closed. The first quarter, 2026, is well on pace to be ahead of prior quarters in terms of number of deals, however, slightly behind in terms of dollar value. So what that in terms translates for us is that managers are focused on smaller deals and add-on activity rather than structuring some of the larger deals, which has come in. Exit environment, as I said earlier, is still benign. We're cautiously optimistic that it's opening up a little bit, but we've, as I mentioned, the slowdown in distributions. Certainly we've seen a muted exit environment, specifically on the small end. The valuations, those are your private company valuations on the right-hand side chart. If you split that in half and really look at 2016 to 2020, you see the valuations level out around 11 times. The other half of the chart, that jumps up to about 13. So similar picture to public markets. We've seen an increase in valuations. Private companies are just valued higher. What that again translates to for us is that you simply cannot rely on higher valuations going even higher in order for you to make money. So you cannot just rely on leverage and financial engineering. Similar to Ethan's comments, our entire portfolio is structured around GPs that have an operational edge, that know a company, can run a company if they have to, and can actually add value operationally and not just rely on leverage. Any questions on that particular slide? If not, I will move on to 47. New commitments page. Again, busy page, close to just over $500 million committed fiscal year 25-26. We are officially done with the last commitment, Tree-Line Credit Strategies. You can see here on the slide, invested in pension cap, trust funds, and state funds. So in trust and state funds, that will be our second private credit investment. This is also a private credit directly in the strategy, similar to Deerpath that we have in those two portfolios. Any questions on that? You do have the board brief in front of you, I believe, for tree line. Highlight a couple of points here. It's a long-standing relationship for us. We've been working with Treeline for almost not quite a decade, I should say. We're committed to 3 of their closed-end funds have recently made the switch to the Evergreen vehicle for reasons that we've discussed in October. More flexibility in terms of ability to allocate for us. Please note that this is not your typical headline private credit strategy that you may have seen pop up in several publications, LinkedIn and wherever not. This is not your semi-liquid evergreen fund with the whole ton of software exposure. We have software in this vehicle. It's about 3%. So not overly grand, but the main structural difference here is simply that yes, this is an evergreen. However, there's no retail investments, semi-liquid optionalities in this vehicle, so nobody can really try to force money out of this vehicle. For us, the only way to do that would be to tell the GPs, okay, we don't want dividends to be reinvested, and we're not committing any further capital, and then we'll let the loan portfolio run out, which will take 2-3 years or so for us to get our money back. Again, the long-term nature of our overall portfolio, that is a good match. Only other point I highlight here is the economics that we're always proud of. Very favorable for us. You can see the numbers on the page. Happy to answer any questions on the tree line specifically.
Any questions?
Thomas, if the latest surge in interest rates hold, is that a little bit more headwind to the GPs over the next year or two?
The high interest rates are actually a benefit to the direct lenders because they usually price everything on a floating rate, SOFR plus a spread. So if the base rates go up, they will underwrite new loans at higher interest rates altogether. So it's actually a net.
I was thinking more the private equity side.
On the private equity side, sorry, yes, the cost of capital certainly goes up. With them to get more leverage will become costly.
Seeing the value creep up, not an enormous amount, but upward, and we're seeing the cost of capital creep upward.
Yes.
Those two things can't be terribly advantageous to.
They're not, and again, I've changed that chart on slide, it was a 46. Traditionally, I've had the breakdown between the equity piece and the debt piece on there. Switched it up this time. But yeah, you've seen that not dramatically, but come down, the equity piece of a deal. So GPs, managers over equitizing, as you would say. Deals. So
or appropriately equitizing.
Appropriately, yes. In my mind, appropriately. If we go back to the 80s or 90s private equity, the leverage piece was 90% of the deal. So they put $10 in, bought a $100 company. We're gotten away from that. It's interesting that the conversation around conservative and risk always comes up when markets are rallying and doing really, really well. Nobody asks you if you're too conservative in the down markets. See. Any other questions, comments? Seeing none, we'll pass it over to Kirsten.
All right, thanks, Thomas.
Thank you.
Hey, good afternoon. I am on page 48 for everyone here. You can see the internally managed core fixed income is sitting just below $15 billion, so about half of the assets under management. A big part of the value add here comes from STIP. That's mostly due to its size and, of course, the high short-term interest rates we've seen the last couple of years. The performance here, you can see we've had some modest outperformance in the last year. We started the year with a yield advantage and have just taken advantage of that. I'll move on to page 49. Corporate and mortgage spreads. While the chart doesn't do a great example of showing it, these are very tight. Specifically corporates, we're seeing close to the 10-year low in corporate spreads still. Doesn't mean they can't go lower, but I like to point that out. The yield curve has steepened significantly over the last year. You can see the front end has come in a lot. That's mainly due to the cuts in September, October, December of last year, 2025. We started the beginning of the calendar year, the markets had priced in 2 rate cuts for 2026. Now the markets are pricing in 0. They're even pricing in a hike by March of 2027. So I heard a That's something that makes me laugh. They say the market's been forecasting rate cuts the way people in Montana forecast spring, repeatedly, confidently, and wrong. So get that there. So with that in mind, we'll move on to how the portfolios are positioned. It's consistent across core fixed income and pension, state fund, and trust fund. It's important to position these for the market we have, not the market that's promised with rate cuts or things like that. So you see we have a slight long duration. This isn't a huge bet by any means, but it does mean if there were if the Fed were to start easing again, we would participate in that, but it's not a huge bet if that doesn't happen. It also allows us to have that slight yield advantage you see here. And because the spreads are so tight, you can see we have a slightly lower contribution to duration. You do see an outweight in the asset allocation to corporates, but that just means our corporates are shorter than the benchmark. We have more of them, but they're not as long. And of course, you know, you saw Jason's chart earlier that John used that shows, you know, 30 years ago, the biggest companies are very different than the companies now. And that's just our team doesn't tend to buy a lot of 30-year bonds. Are there any questions on fixed income? Awesome, I love it. Save the best for last and get through it quick, right? Yeah, thank you.
All right, recap, Dan.
Adding email functionality to Smart Room for the materials. Again, just a reminder, likely need a special board meeting in June for Rose Hills and potentially another loan. It is large, so I'll apply to everybody.
It'll be a Zoom or in person?
It'll be Zoom. And then that's
all the material for this Rose Hills and you'll send out so we have time to digest.
Yes, this will be a big one. We'd like to get at least a week between mailing and meeting because it's the first time we've done one of these, and B, it's a $13 million to $17 million loan. So it's a big one. Otherwise, what do you all need from me?
Do we have a schedule? Were we gonna do a education this year or I mean, I know we, like last year we had discussed like an offsite or anything. Are we doing what was the?
We did that after the second day of the February meeting. So if you guys want another one, we can absolutely schedule it. But for what would have been an offsite, we did that second day in February.
So do you have an idea in June?
No, until I get the materials. And we not only have to get the materials, then Louise has to give it a good underwriting and make sure it checks the boxes. Then we need to get it out to all of you. So I'd say late June, third week, probably at
That's
the
good.
earliest.
Because the other times, you really just need a good internet connection, and there are places in Montana you don't have.
Which golf course? We'll bring a Starlink out for your golf cart.
All right, anything else? All right, thank you. Meeting adjourned.
Thank you, everyone.